The Bloomberg US dollar also has been losing ground and continues to be flat this morning. Brent crude 76.67, so up a touch. Actually, the best week in a couple of months, I think, for oil prices as the risk-on rally gripped commodities.
Futures pointing to add to those year-to-date gains, the year-to-date highs that we saw yesterday. Upside of close to 0.4% over in France. A similar picture in Germany, the FTSE 100 pointing to higher gains as well of 0.2%.
Okay, so looking for more positivity then for European stocks as we reflect on what we've heard from the Fed. And even if European central banks not all speaking from the same hymn sheet as the Fed just yet, we certainly have the Fed vibes filtering through into European assets. We've seen that in sovereign debt. We've seen that in equity markets for sure. So this is the Spanish IBEX up around 0.2%, opening up first this morning. The FTSE is pretty flat. FX markets maybe taking a breather, feeling like they've done too much hard work this week, taking a breather from all of the activity of this week, the weakness in the dollar, the pronounced trend of the week, but now it's pretty flat. So the euro is flat and other currencies pretty flat this morning. And as I mentioned when we were looking at the 10-year Treasury yield a moment ago, we are seeing those yields going a little higher today, but really that doesn't take away from the fact that the biggest story this week has been for yields to be dropping. So we see at the short end just a little bit of a recoup of the recent moves. So the German, the Spanish, the French, the Italian and the Swiss 2-year seeing a little bit of move higher in terms of the yield story. And a mixed picture then on commodities this morning then, Tom.
Yeah, and across your sectors, two sectors in negative territory so far, very early stages of the open this Friday, of course. Healthcare down 0.3%, food and beverage down around 0.2%. We're talking about the yields ticking up a little bit because Anna was giving the context that the moves lower have been aggressive, of course, this week. And so technology continues to breathe a sigh of relief around what has been, of course, over the last few days, a lower yield environment, even as there's a little bit of selling coming through across bonds in the session today. Tech gaining 0.7%. This is the China story, and the link then to Europe once again comes from basic resources, and that sector gaining 1%, a little over 1%, as that increased liquidity comes through from the PBOC, record liquidity, and some of that could filter into infrastructure and lift some of those basic resources stocks as well. Autos gaining 0.8%, so a solid session so far for that sector. Banks also in the green alongside financial services, and again, just two sectors in the red. Insurance took a big hit, by the way, yesterday. That sector coming back, pairing some of the losses, adding 0.4%. Across your benchmark, you're up 0.3 at 477, Anna.
Okay, Sam Unster joins us from the Markets Today blog. Let's take stock of the week. Let's have a look at some of the recent developments from China as well, because we've had that to deal with overnight. Sam, good morning once again. Let's go to the China story, because we haven't got your thoughts on this. And we were waiting for the data. We also thought we might get something from the PBOC. And now, as we've seen both, it seems that maybe the PBOC moves pretty significant in a mixed set of data.
Yeah, so I think, the data quite mixed. That's kind of been the story for a while now. There's not really any kind of great signs of any great recovery or actually particularly any huge weakness. The PBOC move is quite significant, but I think one thing to look at was the credit data we had earlier on in the week. The fact is, if the demand is not there, pumping all the new money in, it's not going to do a huge amount. So at the moment, it still feels, even though it feels like a larger move today, that it's still kind of tinkering around the edges.
Yeah, there's a few threads to tie together today on the China story, isn't there? Because you had changes around property sales and purchases in Shanghai and Beijing to make it easier, essentially, to sell and to buy properties. That's seen as positive. That as the reminder that prices continue to soften across property sales and house prices in China as well. And then the mixed data in terms of retail sales, yes, up 10%, but with the comparison effect as well. When you look to 2024 and how China ties into the European and UK story, how are you thinking about some of the factors that might be the catalysts?
Well, I think so the demand story is the key thing. So as you're kind of talking about there, lots of measures being taken around the edge in China, but none of them at the moment have really started to change the picture. So as we go into 2024, it doesn't feel like the picture's changed all that much. You may well see a rally but maybe more broadly because of wider markets. You know, we're moving into this pivot that we were talking about so much over the course of the last couple of days with the Fed. Easier monetary policy may well lift things there, but it may not be anything to do with China itself.
Yeah, we got plenty of surprises this week, didn't we? Or maybe just one big surprise, the Fed. Mark was saying he was surprised by the Fed. Our guest at 7:10, Ulrich Luckman, saying he was surprised by the Fed. I mean, markets must have been surprised, otherwise we wouldn't have seen such big moves, but I suppose markets front ran that move a little bit. What did you make of what we heard with a bit of hindsight now to sort of put it in context now?
Yeah, I mean, I think I would agree with that. I think how dovish the Fed was a surprise, and I think when we then got to the ECB and the BOE later in the day, you know, this big central banking day yesterday, they broadly were as expected. You know, they're still taking a lot more caution. I think the lack of pushback from the Fed in particular, and you said, you know, some of the air was taken out of the moves by the previous ones. Things still moved a lot yesterday, you know. I mean, and a lot of those moves, as you mentioned today, they may well balance out as people start to look towards 2024. But particularly in bond markets, like there's no sign of that stopping.
Okay, so we tie the moves from the central banks to the FX markets, and I'm looking across the main FX crosses right now, and the moves are far more muted than they have been in the last couple of days. Bloomberg Dollar Index is essentially flat on the day, Euro Dollar at 109, and the pound at 127. When it comes to the US dollar, then, the greenback, is it just a clear call that you get lower rates and you get softer greenback, softer dollar, or is there's a little bit of pushback coming to that view, right?
There is a little bit of pushback coming to that view, and it is basically because you've almost got a kind of a situation where the economies of Europe and the US and you know, if you like to bring the UK into that too, which one is going to weaken the most, right? And so overall, even though the US economy is seen weakening next year, it's maybe not going to be as bad as is seen in Europe in particular, and that may well mean that the dollar actually gets a little bit of support despite those rate cuts and despite that big dovish pivot from the Fed.
Okay, Sam, thanks very much. Thanks for joining us. Sam Unstead from the Markets Today blog. You can find the blog on the front page of the Bloomberg UK website, or you can type TLIV Go on the Bloomberg terminal. Here's what we're watching out for today then. We are due to get preliminary December PMIs from across Europe this morning. We'll get the French numbers at 8:15 UK time, the German number at 8:30, so that's coming up within the next 20 minutes, basically. The wider, 25 minutes, the wider euro area outlook will get that number at 9 o'clock, and the UK number will come through at 9:30. Today is also triple witching, so watch for higher volumes and volatility around all those expiries stateside. At 2:45 p.m. UK time, we'll get S&P global PMIs for the United States, so that'll add to our understanding of those that kind of hot take, if you like, on the growth story. And at 5:30 p.m. UK time, Atlanta Fed President Raphael Bostic is scheduled to speak on the US economy and business outlook at an event at Harvard Business School. And that's where we focused a lot of our attention last hour, Tom, with Mark, thinking about if the Fed wants to push back against how the markets have gripped hold of this dovish idea. If the Fed wants to push back, they've got the opportunity with Bostic today. They don't have that many opportunities towards the end of this year, though, so we'll see if they grasp that opportunity or not.
Yeah, and you just wonder, given the press conference and given that Powell did give this pretty dovish message, he had the opportunity to push back in that press conference. He didn't do that. Whether or not the likes of Raphael Bostic are really going to come back and push back. He's not been traditionally in the hawkish camp. But given the dot plots are now pricing at 75 basis points, and that is essentially, of course, reaffirming the market moves, but still a ways away from the 150 that we're pricing for the markets, there is that option, of course, and whether or not the bond markets actually react to any kind of pushback, given the expectations now. And
we're looking for these PMI numbers to come through from first in Europe and, well, the EU and then the UK and then the US a little bit later. I'm really interested in this the French number, the fact that the composite PMI for France could have a 45 handle. That is at least the estimate, whilst Germany has a 48 handle. And, you know, this underlining other areas of weakness away from just Germany.
Does the lens in 2024 move from Germany to France in terms of the weak nations across the Eurozone and the vulnerability there? And again, France and French officials saying we are not expecting a recession, but clearly the data is going to suggest that there is a little bit of softening coming through. That is the flag. We'll see the data when it comes through in the next 10 minutes.
Yeah, it's been a very different energy story, of course, and that was the backdrop to a lot of the early German weakness, but maybe thinking moves on. Coming up on the programme, the ECB and the Bank of England didn't follow the Fed's lead in discussing rate cuts. We take a look at what this week's central bank rate decisions mean for the global economy. That's next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg. Welcome back. It is 11 minutes past 8 here in London, so 11 minutes into our European trading day, and making modest gains across European equity markets, up around 0.2% on the Stoxx 600. Let's get to the individual movers, though. Some interesting stories in the mix this morning. Joe Easton has a briefing. Joe.
So we've got two big movers to start with at the moment. At the top here, Trainline up 15% as the UK government announces that it will now not launch a rival online booking platform for the train industry. They announced it a few years ago in order to revitalise the sector post-pandemic, but they will now not do that. Trainline has around 60% share of the online booking market, so that stock rallying massively now, up 17% almost in London. And Campari going the other way. This one a little bit surprising. All the analyst notes I read were very positive on Campari buying that company that makes Courvoisier cognac. There's a Japanese firm that owns it, and they are looking to get a stake in that market, the owner of Aperol Spritz. But that one declining. It is $1.2 billion worth of cash that they're having to spend in order to buy it, so potentially just looking a bit pricey. In terms of that, we need some train puns as well, so investors all aboard with Trainline. I'm going to go with that one, but I've gone off rails a bit, so I'm going to go back to chemicals. Chemicals getting hit today. We had a profit warning from Germany. Symrise at the top here, down 9% on the DAX index. They announced that they had actually ups their revenue target, but their profit line is coming down. It was further down in the statement. Analysts pointing to negativity. They make things that go into fragrances, food, all those chemicals, and we're seeing Gavaldian over in Switzerland, Croda in London, and DSM in France all hit as well. So chemicals, one of the worst performing sectors in Europe, following that warning from Simrise this morning. Couple of other ones. We've got a few rating changes coming in as well today. I think we have one over in the used car market, which we don't look at too much. Inchcape, this one is a new outperform over at Exane BNP Paribas. They say that the company is pivoting away from the UK towards developing markets where it is untapped. Lots of room for growth over there. A couple of interesting ones in reaction to what we saw yesterday, given the Fed pivot. EQT was one of the best performing stocks in Europe yesterday. It's a private equity firm. Lower rates means it's more easy for them to do deals, and that one does get an upgrade over at JP Morgan today. Nokia is double downgraded by Citi. They go from buy to sell. That is having a terrible year. That stock down around 30% as they lose contracts, including the big AT&T one, which we covered earlier in the week. And finally, we got a share placing out of Shah Gurs. Now, this is an online digital company, bit of a smaller cap firm, but the company announcing that the management is looking to buy it at the same time of potentially selling more shares over to private equity. And that stock gaining around 29% in the smaller to mid-cap market. That's Shah Gurs, up 29%.
So those train puns did not hit the buffers, I promise you. Certainly not with Anna. She's
now
a big,
you're
big
both going off the rails.
It's contagious.
We're on fire this Friday. Joe Easton, thank you very much indeed from our team. We'll try not to emulate you next time. Doesn't work really, does it? Right, Europe central bankers, are they off the tracks, on the tracks? Where are they heading? They're in no hurry, it seems, to join the US. Pivot towards interest rate cuts. This after the ECB President Christine Lagarde and her counterpart Andrew Bailey at the Bank of England, of course, declared that further slowing in inflation can't be taken for granted. While investors are still betting on cuts in Europe that central banks won't endorse, they are beginning to align to a timetable where the Fed cuts first. Joining us now for the analysis, Dirk Steffen, Chief Investment Officer, EMEA and Global Chief Investment Strategist at Deutsche Bank. Dirk, good morning. Thanks for joining us. Has this market rally run too far in light of what we've been hearing from these central banks?
Yeah, good morning. Thank you for having me. So I think the markets are getting ahead of themselves a little bit. So we're seeing a process where, everything is being priced in that's going to come in 2024 in no time. So this is probably a bit too much already. So we think, especially in terms of cuts on the side of the Fed and also on the ECB, we should be more cautious. So we think it was actually right for the ECB not to tune in with Jay Powell too much at this point in time. So of course it will be data dependent, but we think some repricing is already necessary.
Okay, let me just pivot to the European story for a moment. Good morning to you, just because we've just got some data hitting the Bloomberg terminal, so I'll work that in. We've got the composite PMI falling to 43.7 for France. This is in December. The forecast was 45. And we see on the services side and on the manufacturing side that these numbers are coming in lower than expected. I wonder, in terms of the conversation about vulnerability and the European growth story, Dirk. I mean, this is the French story, maybe catching down a little with the German story of last year.
I mean, the European growth story isn't really there, is it? So we like to say that as we didn't have a severe recession over the last winter, we don't have a boom thereafter. So we're just, sort of growing along somewhere between 0 and 1%, not much to expect here. And I actually think that the inventory cycle is about to turn, so that might mean actually better news for Germany for the next couple of months or so. And I think the ECB is, of course, in a position which is much more difficult compared to the Fed because they still have price pressures. We are still a bit behind in the cycle. And at the same time, growth is much weaker than in the US. So it's not enviable, let's put it mildly, for the ECB.
Dirk, how challenging is it to set those earnings forecasts for European stocks as you look into 2024, given the disconnect between market pricing and what we've been hearing from the ECB? How are you folding that into your earnings forecasts?
I mean, actually, it's an easy one, especially for Germany, because we actually have to look at global growth and what it offers, because, we are always being asked, what does it mean, Germany being in a technical recession every other year? What does it mean for earnings for the DAX? And actually, it does mean very little. So, of course, the home market is very important, but the global economy is actually outpacing it. So that's why we are watching so much more on China, and actually today's data was quite comforting, at least on the production side. So so that's the situation we're in, I guess.
Comforting out of China. Less comforting than this data coming through on Europe. We've just got the French picture so far. We'll look ahead to the German picture, and maybe things are bottoming out, as you say. Do you see the ECB on this different trajectory to the Fed for very long, or do you think the ECB will also make some sort of pivot in the new year?
I mean, they probably they will consider it, I guess. So. But as I said earlier, so we are maybe 6 months behind in the cycle. So that's why they're really postponing that decision. So we think both the Fed and the ECB will actually wait probably until June to go for the first cut. And then it will depend a lot on the data. I mean, let's not get carried away by a few data points, because we all know that the oil prices are also helping in the background. If that's turning, you might get some problems. Let's not forget that unemployment is at a record low in the Eurozone, which is, providing the potential for second round effects and so on. And I guess that's really on the mind of the ECB.
Dirk, how much conviction do you have in terms of wanting to lean in still to those growth stocks? And that takes you to the US. Just talk to us about that call.
Yeah, I mean, it's, the big debate has been, okay, the Magnificent Seven, is it, still time to get involved or not, or has it run too far? And we actually, after many months of thinking about it, we took the decision that we would like to stay with the winners of 2023, also for 2024. And the reason is really pricing power, it's profitability, it's the lack of growth generally, globally. So that's why we are actually trying to put our money on growth stocks, and we think it's worth paying the price for it.
Dirk, thanks so much. Thanks for joining us. Dirk Steffen, Chief Investments Officer for EMEA and Global Chief Investment Strategist at Deutsche Bank, with some of the views as we head towards the end of the year. Coming up on the programme, we'll get to the retail story this morning. H&M sales come to a halt in the latest period. Does the fast fashion retailer need new clothes? We will discuss. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Business Week Radio, live week. Weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. Happy Friday, 24 minutes into your European trading day. You're seeing modest gains around 0.2% because, of course, building on the gains of yesterday for European stocks across your sectors. Autos at the top, chemicals down at the bottom, down 0.6%. But again, broadly, a positive session for European stocks. Slightly different story for H&M in the retail space. H&M sales fell in the fourth quarter as the company faces mounting calls to clear its inventory. It's a problem that it has faced for years. Rival Inditex, which owns Zara, this week reported the slowest quarterly revenue growth in almost 3 years. Joining us for more is Bloomberg's Dasha Afanasieva. Dasha, why the weak numbers? What's happening with H&M, the softness that's coming through for sales?
Morning. So it's a combination of both a weaker consumer, that's something that's arguably seen in the sector because of the cost of living squeeze, and also increased competition from labels like Shein, which is going to IPO soon.
Okay, so the competitive landscape in focus. Is there read across then from these results for other clothing retailers, or is this more H&M specific?
I think there is read across just because of this undercutting and these super cheap items, sold by Misguided, Shein, and, companies like H&M and Inditex, which is also fast fashion, but just that bit more expensive, with that a little bit more transparency about where your stuff comes from and where it's produced. They're really feeling under pressure. But there's also a read across, I think, to the consumer goods sector. I think the companies that I speak to, it does sound like they're expecting quite a weak fourth quarter. And we can see that in how well they performed in the first 3 quarters, but then didn't change their full year guidance. That's the case for Unilever, for example.
Do we have a sense of what the response is going to be then in 2024 from these companies? Is a price war what we should be bracing for across some of these retailers as they contend with that competition?
The focus is going to be bringing back market share. I mean, particularly for the consumer goods groups that have lost market share to supermarket retailers, supermarkets. And I think for the retailers, they've lost market share to the cheaper brands. So it's going to be about discounts. It's going to be about investing in promotions to win back that consumer. So expect big sales, I guess.
Okay, something to look ahead to. Dasha, thanks very much. Dasha Afanasieva from the Bloomberg Consumer team joining us for the latest on H&M and the sector. Quick word on the macro, Tom. Yep. Disappointments around the French numbers. We've had those so far. And in 20 minutes, we'll get the numbers out of Germany. This is the PMI first look at that data. And interesting to see that the euro has dropped on this and bond markets have responded.
And for the context then, that manufacturing print for the month of December, PMI manufacturing for France coming in at 42, again, below the surveys, below the previous month, and the lowest print that we've seen since March. In fact, I should say May of 2021. So it's significant in terms of the softness coming through there, and services coming in at 44.3. Of course, both numbers well into contractionary territory.
Yeah, coming up on the programme, then we'll get back to the Fed conversation. The Fed lifts oil, but one report says global demand may still slip in 2024. We'll get back to the drivers in the oil market. There's the supply side, of course, with OPEC Plus and its plans for the future. There's also plenty to talk about on the demand front, with the US economy in focus post the Fed, but also the Chinese demand story. We'll get into that conversation shortly. This is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European stocks trade higher as investors pin their convictions on a coming Fed pivot. The ECB and BOE push back on the market's dovish tilt. Hungary's Viktor Orban blocks an aid package for Ukraine as he pushes for the EU to release withheld funds for his nation. But the European Leaders Summit does agree to open membership talks with Kyiv. Plus, French services and manufacturing PMI readings both show contraction, coming in below all estimates. We will bring you those numbers out of Germany and across Europe as we go through this morning. So that's the markets picture, the data picture, if you like, and that's certainly building. Yep. We've had a lot of central bank news to deal with this morning, Tom, but increasingly focused on the weakness of some of this European data coming through.
Yeah, and we'll see if the German data also confirms that softness. In the last few months, manufacturing prints out of Germany have actually been improving slightly, but still firmly in contractionary territory, that data dropping just in the next couple of minutes. In fact, we have the data right now. Let's start with services data then. PMI data for the month of December falling to 48.4, below the forecasts of 49.8, so still in contractionary territory for services. More importantly, though, for manufacturing, keep the prompt going, we're seeing December manufacturing data out of Germany then coming to 43.1, roughly in line with the forecasts of 43.2. Again, in the last few months, I'd say 4 to 5 months, the last time I checked, this manufacturing data out of Germany has improved marginally, but clearly it is still below, comfortably and significantly below that 50 line. So 43, they're not going to take much comfort from that number. It's still firmly in contraction. But again, the context is that you got the low coming through earlier this year, July, of around 38. So you've moved from 38 to around 43. So it's moving in a slightly more positive direction in terms of the manufacturing out of Germany, but it's still firmly in contraction. Of course, the China story is big and a big part of that. Euro-dollar worth reflecting, of course, on the single currency, and moving lower then on the back of this data coming out of both France and Germany, down 0.4%. Of course, Christine Lagarde yesterday saying they haven't even discussed cuts, but markets are, of course, expecting that the Fed and the ECB will cut roughly about the same amount and roughly about the same amount of time in 2024. Across the equity markets, you're looking to build on the gains of yesterday then, 0.4% across the European benchmark at 478. We got to a year-to-date high yesterday across the benchmark. The DAX is doing very well thanks to the auto sector, and we'll reflect on that briefly when we flip the board. But right now, you're adding 100 points across the main German index, up 0.6%. And China is also a story. The liquidity being pumped into the financial markets, a record amount of liquidity into the financial system of China, and that could filter in to infrastructure and spending on basic resources. Bit of a lift coming through for the FTSE 100 then on the back of that sector, 7,659 on the main index here in the UK, adding 11 points. Across your sectors then, let's reflect on how this is breaking down. We saw moves, of course, in sectors like technology. Yesterday, real estate was at the top of the list, gaining more than 5%. Today, just two sectors in negative territory. Food is down 0.5. Health is off just 0.1%. The strength coming through for financial services. Banks also doing moderately well, up 0.4%. Tech adding 0.5. But the real strength coming through for the auto sector, 1.7% is the gain there, and that's coming through that big lift for the DAX. Basic resources, as I was saying, linking to the China stimulus story, or at least liquidity story, gaining 1.5%. And energy, we could be on track for the first week of positive gains for oil prices. Energy up 1% across your benchmark, Anna. 0.4% is the gain.
And we'll pick up on that energy link in just a moment. Just worth reflecting on that data that we had out, though, on Germany, Tom, and the weakness in the euro that results, the weakness in yields across Europe that results. And is this the market then thinking that the ECB will follow the Fed sooner than perhaps we previously thought, based on some of these early data points? And it is just this forward-looking PMI data set that we're building this morning. Let's, though, Tom, go back to that energy story that you set up so nicely there. Oil looks set to see its first weekly gains following nearly 2 months of losses. The Fed's dovish comments helped weaken the dollar and boost bullish sentiment across markets. However, the International Energy Agency is warning of a bumpy road ahead for traders in the sector. In its latest report, it says evidence of a slowdown European oil demand is mounting. Joining us now is Louise Dixon, Head of Oil Analytics Research at Rystad Energy. Louise, nice to have you with us. I just wanted to jump off some of the big macro themes that we've been dealing with this week and what they mean for oil. We've seen this pivot then from the Fed. We've seen the Fed turning more dovish, so we expect the rate cuts next year to come sooner than we previously thought. Now, that's had a positive impact in the very short term on oil, but if it does reflect underlying weaknesses in the global economy at some point in the future, I suppose it's not oil positive. How does the macro play into oil at this point?
Hi, and thanks for having me. There is a very established correlation between oil demand and PMI. So if we, are even in the numbers that we're looking at, or even looking at the consensus, for example, for what the IEA is publishing, even a reduction of 100,000 or 200,000 barrels per day is going to have a pretty big macro impact. So right now we're penciling in about 1.3 million barrels per day of oil demand growth for 2024. But much of this is hinged not sort of on the Western economies that are kind of already in this monetary pivoting, but as well from the emerging markets. So we have to as well look quite east and see what's happening with the PMI, and the macro data coming out of there is not as rosy just yet.
Yeah, so as you look east and you talk about the lack, or at least the less than rosy picture coming out of EM, and particularly, of course, I would have thought China, given the data we've talked about today, softness again. Okay, there's a bit of growth coming through, but we're not back to the kind of strength that many had expected. How much transparency, Louise, do you think you have? How much clarity do you have in terms of the demand picture coming out of China for next year?
China, listen, Tom, China is going to be the biggest unknown for 2024. And as we've seen in 2023, it's been by far the largest bullish confidence trap. So we thought China was going to reopen after the pandemic. We thought oil demand was going to have this very springy V-shaped recovery. And it's to borrow the IEA's terminology, it has been a very bumpy road, in particular in that region. So we're looking on a daily basis at traffic across all sectors. We're looking at road, we're looking at aviation, and we're seeing exactly the demand for which fuels. And we're, again, penciling in about 600,000 barrels per day of oil demand growth out of China for 2024. And much of that is dependent on how the economy performs. And will people get on planes? Will there be aviation demand in 2024? So there's, of course, some downside risk to that view.
Okay, and then what about the European story, Louise? We've been dealing with some weakness or ongoing weakness in European data really for some time. Where does the European demand story feature in your thinking?
Well, I think the particular weakness that we've seen in oil prices in the past, let's call it like 2 months, that has really been less looking east, but more looking west. So that has been in part due to some of the refinery outages across Europe and the lower and sort of, we can call it actually weak and soft refining margins, both in the US and Europe. So refineries in the US and Europe have seen these low, gasoline, diesel prices. I think even in the US, we're at a 6-month low. We're at $3.20 per gallon for gasoline, which is great for the consumer. But if you're on the other side of it, if you're a refiner, you have to make some tough decisions. And you can either decide to run a bit less crude, or you can try to, run the same amount of crude and then hope that you can find a home for these refined product exports. And so far, we've seen a continued weakening in these margins, and then refiners having to make, similarly rationalized decisions based on this.
Louise, when you think about OPEC Plus, they've been, at least rhetorically, out front, talking about the unity that they have around these continued cuts into 2024. But we know there are cracks. We know there are divisions. How are you thinking about the risk that OPEC Plus unity breaks down in 2024?
I think that the schism is maybe an overplayed story. I do think that the unity between the production group is quite robust, and really what they're up against now is sort of the growth of U.S. shale. And it's a slightly different story than it was 2 or 3 years ago when OPEC could sort of, pull the trigger on supply and then actually have a reaction from U.S. shale. And it's a bit different this time around simply due to the fact that there are sanctions against Russian barrels, and this isn't going to have the same impact as it did 2 or 3 years ago. And then on the other side of the OPEC plus equation is, of course, Iran. And that oil lever is as well, you have to look west. You have to look to the U.S. election in 2024. Under the last 2 years of the Biden, the last 2 to 3 years of the Biden administration, we've seen Iran, be able to extremely ramp up their oil production. And whether that's going to be allowed to sort of be continued into 2024 and thereafter is very much going to sort of depend on what's happening in Washington.
What kind of response do you expect to see then, Louise, from US shale coming on the back of COP28 and the agreements that were made there, of course?
We at US shale we're talking already about the third wave, and it's not going to be as strong as sort of the second boost in production that we saw, but we are already past 13 million barrels per day in US production, and we're looking at a potential growth of another 500,000 barrels per day, even next year. But yes, you are correct that eventually the group of producers in the U.S. is going to have to look at their emissions, and they're going to have to put together a corporate strategy that is taking into account these new COP28 promises and expectations.
Okay, Louise Dixon, we appreciate the insights. Head of Oil Analytics Research at Rystad Energy. We look at Brent, $76.84, up 0.3% in the session. WTI at 71.85, up 0.4. Let's get back to the macro data picture then that Anna was tying into that conversation out of Europe. Euro-dollar softening on the back of a miss of prints coming through from both Germany and France on both manufacturing and services. Euro-dollar at 109. And just for the context, you missed on manufacturing, services and the composite out of Germany for the month of December, and it was a similar picture over in France. So just the softness of this Eurozone economy coming back in focus for markets now.
Okay, and we'll be back to the politics shortly to get an update. Budapest says it won't support a new EU aid package for Ukraine until the bloc pays out all of the funds withheld from Hungary. Orban playing that card. We will get the latest from Brussels. That's next. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Markets Today, 45 minutes into a European trading session that shows increasingly positive gains across European stocks. The US picture then coming off the strength of the post-Fed rally. We are looking at futures that are up by 0.2% stateside. Now to the politics of Europe, and Hungary's Prime Minister Viktor Orban says he won't support a new EU aid package for Ukraine until the bloc pays out all of the funds withheld from his country. But in a significant political victory for Kyiv yesterday, the EU unexpectedly agreed to open membership talks with Ukraine. For more on these two developments, let's bring in Bloomberg's Maria Tadeo, who is with us, of course, from Brussels. Maria, how significant are these two decisions then around Ukraine, sort of pulling in different directions, but give us their significance?
Yes, Anna, in very different directions. But when you come or you look at the two items, one was approved, another one was not approved. But when you look at what was agreed yesterday, and that is, of course, the accession talks for Ukraine, that is a possibility now. That sets the wheels in motion for Ukraine to join the European Union one day. We know it's not going to be overnight, and we know this is going to be a long, hard, difficult process for the country. But nonetheless, it was incredibly important for Ukraine to get that political signal. Remember, the Ukrainians applied for membership of the European Union just days after Russia invaded the country. This has become almost the centerpiece of their foreign policy, and a lot was at stake in that political decision. And that was agreed yesterday unanimously. Just to give you some color, however, in terms of how European leaders got there, we were expecting this was going to be a very difficult decision. In fact, we were told, get ready for a summit that could go all the way into Saturday, maybe even the weekend. And then, no, it happened very quickly, and a lot of that was prompted by Viktor Orban, the Hungarian prime minister, who said he could not agree fundamentally to Ukraine in this accession process, deciding he would leave the room. He would not be present at the time of the vote, and then therefore the vote happened unanimously because Viktor Orban was not present at the time where the rest of the 26 voted in favor of accession. So that is one of those almost magical moments that happens at times in European decision making that ultimately leads to a deal. Where we don't have a deal as it stands this morning, it's for the financial package for Ukraine. That is 50 billion euros for Ukraine. That would be help and aid for the country distributed in 4 years. There is no agreement on that. We knew that the money issue was going to be particularly thorny, and that feeds also, into the difficulties that Ukraine is already facing in the United States. So there is clearly a question and a problem around the funding for this country over the long term.
Well, indeed, and Ukraine says that funding need is urgent. What is your sense, Maria, with your sources on the ground in Brussels, with your sources in Ukraine, as to whether or not the EU can deliver where the US, at least in the most recent tranche, has failed?
Yes, and of course, Ukrainians knew that at some point fatigue was going to kick in, and they were aware of this. I think they have been taken aback by the fact that it is happening so soon. There's still a year to go before the U.S. election. They did not expect, U.S. side, that Ukraine would become so politicized a year before the election, and obviously that is a problem. When it comes to the European Union, as I said, Viktor Orban said out of principle yesterday he could not agree to this 50 billion euro package, but what I'm being told behind the scenes is that it's not just Viktor Orban. There's a number of other leaders who agree in principle, but say that the formula behind it still needs to be worked on, that they need to figure out the financial deals, and this is complex in terms of how it will impact other parts of the European budget. Having said that, on a more positive note, I'm also being told that European leaders will probably convene again in January. There will be an emergency summit that is not in the agenda, maybe at the end of the month, and they hope that at that time there will be a breakthrough for the 50 billion euros for Ukraine Ukraine over a 4-year period. I should also note the works of the Dutch Prime Minister Mark Rutte saying, I do believe a deal on the funding is possible. It just needs more work. We will be back in January, but this is salvageable. We can still get to a deal and provide the funding. The problem, of course, for Ukrainians is that they say time is of the essence, and clearly from their perspective, it's not just a political win that they need, but they also say we need weapons, money, and anything that we can get as soon as possible.
Maria, thank you very much. We'll look to January then and see if we get progress on that other matter then for Ukraine. Maria Tadeo with us from Brussels. Let's get to some of our other top stories this morning on the Bloomberg terminal. Bloomberg has learned that Citigroup is to close its municipal business, one of the most dramatic moves yet by Chief Executive Jane Fraser, as she looks to squeeze better returns out of the Wall Street giant. The bank has decided the business, which has tumbled in the rankings for underwriting state and local debt, is, quote, no longer viable. The move will affect about 100 employees. Meanwhile, GM is cutting more than 1,300 hourly jobs at a pair of plants in Michigan. It comes less than a month after a new labor contract was ratified by its unionized workforce. The impacted facilities are in Lake Orion, outside Detroit, and in Lansing. The staff reductions are effective as of the start of next year. U.S. Treasury Secretary Janet Yellen says she plans to visit China again next year and wants to focus on what she called difficult areas of concern. Speaking at a U.S.-China business event, Yellen also said decoupling from the world's biggest economies would be damaging.
As I've said before, America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country. I and other U.S. officials have repeatedly stated that the United States does not seek to decouple from China. This would be damaging to both our economies and would have negative global repercussions.
Coming up, the ECB and BOE did not, of course, follow the Fed's lead in discussing rate cuts. But is the message from the ECB already looking outdated, given the weaker data that's come through this morning from France and Germany? We discuss. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today. Happy Friday, 54 minutes into your European trading day. Gains of 0.4% now across the Euro benchmark and moves into sovereign debt again. Yields down in Germany and in France on the back of softer economic data. Let's get the context, the analysis then, and bring in Bloomberg Markets reporter Justina Lee. Justina, talk to us about the market reaction then. It seems like we were ever closer to confirming a recession in the Eurozone with this softer data out of both Germany and France.
Right. I mean, both of those numbers were disappointing. I mean, people kind of expected another number below 50, which indicates contraction, but it was even worse than economists expected. And I think it's an interesting data point coming after what the ECB kind of indicated yesterday, which is that, you know, it almost felt like they were subtweeting the Fed, like they're not even talking about rate cuts, unlike the Fed. Yeah.
Yeah, interesting. With PMI data so much below 50 to not even have it on the agenda. So that's interesting in itself. We'll see if that's the same next time around then, I guess, and perhaps the point at which that narrative changes from the ECB gets closer. Thinking about the week as a whole then, Justina, and the sort of post-Fed rally that we've seen in everything, I mean, stocks and bonds in particular, but also commodities. Does this look like a move that stays, that sticks to the year end?
Yeah, I think that's definitely the right question to ask here, because even before, you know, the Fed indications this week, the market, both bonds and stocks, already rallied into it. And currently, markets are still expecting more rate cuts than the Fed projected yesterday. So I think the question here is, like, I mean, are markets being overly optimistic like they were this year? And I think that's definitely the question to be asking here, given that we've seen everything risky, you know, from small caps to kind of like value stocks, everything rally this week.
Yeah, it's interesting that Mark was casting it as that catch-up trade, wasn't he? Referencing small caps and things that had missed out.
And to what extent is that pulling cash off the table out of those money market accounts then, Justine? Do we have a sense of that just briefly?
Actually, so far, money markets are still getting a lot of inflows. Of course, kind of equity inflows kind of also held up. So we'll have to see kind of whether retail sentiment kind of starts to shift as well.
Justina, thank you very much. Thanks for joining us. Bloomberg's Justina Lee with the latest on the markets. That is it for Markets Today. You can get insights from the team, from the Markets Today blog, of course. You can go to the Bloomberg UK website, type TLIV Go on the Bloomberg terminal. That will also take you to the blog. The Pulse is up next. They'll continue to take you through this post-Fed, post-ECB, post-Bank of England market reaction that we're seeing here. In particular, focus on the Fed, of course. US futures pointing higher, up by 0.2% stateside. Have a good weekend, everybody. The Pulse is next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Private sector activity in the euro area's two biggest economies worsened at the end of the year, increasing the risk of a recession in the second half. Hungarian Prime Minister Viktor Orban says his government will not support a new European Union aid package for Ukraine until the bloc pays out all of the funds it's withheld from Budapest. Plus, our exclusive conversation with the Campari Group chief executive on the company's biggest ever deal as it buys Courvoisier Cognac. Now, let's take a look at the European markets map. Again, we're seeing a bit of euphoria across the board. Maybe not euphoria, but certainly we're seeing gains across the board. So the FTSE for the moment is unchanged, but the DAX is getting some 0.6%. The CAC 40 also getting a nice little lift. This equity's really holding on to gains after the Federal Reserve validated bets that it will soon move to easier policy and push stock market gauges towards all-time highs. Now, we are getting some data out of the euro area. December services PMI falling to 48.1, and now anything below 50 means contraction. The forecast was of a 49 number, and then if you look at manufacturing, so that was services, if you look at manufacturing, also below estimates, the forecast 44.6, it came in at 44.2. Now, we've had the ECB and the BOE reluctant to follow the Fed chair, Jay Powell's pivot towards rate cuts. The euro area central banker said that slowing inflation cannot be taken for granted.
We did not discuss rate cuts at all.
Clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
No discussion, no debate on this issue.
Inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
Should we lower our guard? We ask ourselves that question. No. We should absolutely not lower our guard.
We still have a ways to go. No one is declaring victory. That would be premature.
Our past interest rate increases continue to be transmitted forcefully to the economy.
I think you can say that there's little basis for thinking that the economy is in a recession now.
The economy is expected to recover because of rising real income, as people benefit from falling inflation and growing wages, and improving foreign demand.
Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully.
Well, joining us for a look at the market moves following all of this central bank action is Jamie Rush, Chief Europe Economist at Bloomberg Economics, and Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. So thank you both for joining us. Wei, let's start with you. It's been quite a week for the central bank pivot. How many cuts are you expecting from the Fed?
Well, certainly the number of cuts that we should be expecting increases after the Fed meeting this week. The bigger picture is, though, that the Fed has essentially boxed itself in by not leaning against market aggressive pricing for rate cuts. This is a very unusual environment of heightened macro uncertainty. And instead of leaning against market pricing, the Fed actually added fuel to this immaculate scenario. It can still happen, but it's just so much uncertainty around it, and it boxed itself in. We think that greater volatility could come off the back of that. And also, certainly, we have greater conviction that inflation would settle higher and above target because of this pivot that we saw this week.
So, why does that mean you think markets are actually just getting ahead of themselves in terms of how many cuts they're expecting next year from the Fed? And so will they inevitably be disappointed?
Well, markets are currently pricing 6 cuts for the Fed, 5 cuts for the ECB, and 4 cuts for Bank of England. And those are numbers, those are chunky cuts, even more dovish than what the Fed themselves are signaling, right? So there will be some sort of reconciliation through the course of this year. But for as long as the Fed is doubling down on this narrative, I definitely don't want to go against it. So from now until the year end, momentum is strong. Even though the ECB and Bank of England were trying to push against it, obviously the Fed narrative dominated. If you look at yesterday's reaction, yields were falling, equities were going up, even as the ECB and Bank of England were trying to kind of push against market pricing. So for as long as the Fed is keeping up the narrative, we think that momentum can continue. But as this everything rally continues, it poses valuation challenges that definitely sets the stage for being more selective in the new year.
Jamie, what's your take on, and we were joking a little bit about this yesterday morning, the fact that, Jay Powell probably made the job of Christine Lagarde and, of course, of Andrew Bailey so much harder, but they really had to push back against that narrative that the fight against inflation is one.
Yeah, I think unfortunately for Bailey and Lagarde, markets are listening to Powell and they've responded pretty aggressively. They're not listening to Lagarde, they're not listening to Bailey. And I think it's a different emphasis. The Fed is looking ahead, right? So they're saying if we cut when inflation is at 2%, it will be too late. Whereas the Bank of England and the ECB are still very focused on the current outturns for inflation, for wage growth, and so they're being more cautious. But I think as we kind of get into the first half of next year, that narrative could change, and we could see that the ECB and the bank are starting to look further ahead, and therefore that would, of course, be the thing that unlocks an earlier path for rate cuts.
Wait, was there always a bias actually in the markets expecting cuts? So I know they were listening to what Jay Powell said, but was there always the kind of belief that cuts were coming even when central banks were pushing back against that, including Fed officials?
Well, if we look back on 2023, there are multiple episodes where markets were just trying to read into whatever it can read into to support a more dovish narrative, only to be disappointed later, right? But the difference this time is that the pivot is pretty distinct, and the Fed is now talking about rate cuts. So the big picture is, as we look ahead to 2024, it will be a year of rate cuts as opposed to this year and last year that were defined by rate hikes. And against this backdrop, actually, cash has served us well, yielding 5%. But after peak rates, we got to think about putting money to work, putting cash to work, because in periods after peak rates, cash tends to underperform equities and bonds, which is why we're now keen to really think about the selective opportunities that we can take advantage of as we think about the year that is going to be characterized by rate cuts.
And so how do you take advantage of that in a market's perspective?
Well, right now, if you think about the very narrow market still, for example, in the US, as you know, Francine, we have been hiding out in tech and AI theme and barbelling that with front end of the curve. We lean into duration in Q4. We trimmed a little bit, but our current neutral allocation to duration still stands in contrast with the long held underweight that we had for 3 years prior to Q4. So leaning into duration within fixed income inflation-linked bonds actually could start looking interesting now, especially given the pivot, giving us greater conviction that inflation would settle at a higher level. Within equities, while our tech and AI theme has served us very, very well, and we continue to have the overweight, but I cannot help but wonder the laggards, the likes of small cap, the likes of REITs, the likes of value, we're just waiting for the pivot that we saw this week to actually start to outperform, which we started seeing, but given the very meaningful underperformance that they have delivered this year, there is a considerable room for playing catch up. So again, this is more of a momentum type of play that may well be shorter than the horizon that I typically look at, which is 6 to 12 months, but momentum is really strong. So that together with the year-end technicals may well mean that there is more runway to to go. The last thing I would say, emerging markets. Emerging markets central banks have been waiting for a notable signal like the one that we saw from the Fed this week. So emerging market valuation is attractive, and central banks already ahead of the curve with rate cuts, and now they could really be well positioned.
So, Jamie, talk to me a little bit about whether you've changed any of the calls, for example, for the Bank of England. I don't know whether it makes sense for them. I know the market is pricing in possibly too many cuts at the moment, unless they're also trying to cushion the mortgage market. So that would be quite a clever way if they bounce it right, to get it right.
Yeah, I mean, we have nudged our Bank of England call slightly forward, so we now think they'll cut in June. We had previously thought August. And really, that's not because of the signalling from the Bank of England, but rather the change in the global mood music. And, you know, no central bank is going to be immune to the Fed cutting rates aggressively in the first half next year. So we have brought that forward. For the ECB, it will depend on the path of the economy. We are now seeing a little bit more weakness, as we saw in those PMI readings this morning, suggesting that perhaps the GDP is going to track a little bit lower than the ECB is suggesting. If that turns into a more kind of pronounced or more visible downturn, that's going to bring market pricing in line with March potentially. So you know, we're going to be monitoring the economy, monitoring inflation. We're looking for inflation to dip quite sharply in the first quarter of the year after rising in December. The ECB could quite reasonably cut at any point in the next 6 months.
Jamie, what's your take on ECB? Again, I mean, the press conference was quite masterfully in trying to navigate quite a difficult situation for Madame Lagarde.
Well, they were never going to be able to push back on market pricing. There's nothing that she could have said which would have changed markets' view. I think the way she articulated the decision around the first quarter was quite helpful. She kind of pinned the decision on data that wouldn't be even available until after the first quarter is over, which helps give a little bit of clarity on the kind of inertia that the ECB is likely to be involved with if the economy holds up over the next few months. But again, if things change, and if the PMIs really dip in the first quarter, then the ECB is going to be under tremendous pressure to cut. And if the Fed goes in March, then clearly there's a possibility the ECB does the same.
Thank you both for joining us. Jamie Rash, as ever, Bloomberg Economics, and BlackRock's Whaley stays with us. We'll talk a little bit more about China, because coming up, China's central bank offers a record $112 billion of loans to commercial lenders, just as economic data from Beijing comes in mixed. Well, Whaley stays with us to discuss that next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, the conversations that matter, the insights that you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Asian stocks rallied today after China extended its support for the economy with the largest injection of medium-term policy loans ever. New data from Beijing, meanwhile, shows the economic recovery remains fragile amid a housing slump and weak demand. Well, still with us, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. So, Wei, first of all, thank you for sticking with us, but how do you play China into 2024?
Well, it's really interesting. On the one hand, the market is cheap. It has underperformed broader equity market so far this year. On the other hand, sentiment is still really quite negative. And today's reaction to the announcement from PBOC is very telling, right? It's record injection of cash in the financial system. And yet, if you look at the onshore equity market reaction, last time I checked, half an hour ago, Shanghai Composite, well, it already closed when I checked. So it was down 50 basis points on the day. And offshore market, the H shares market, they are up, they are getting excited. But it really speaks to how reluctant kind of onshore sentiment wants to react to any sort of support measures from central authorities. And this has been the theme through the course of this year. If you look at the latest data, industrial production was good, but retail sales was not so good. And this is illustrative of the muted consumer sentiment in domestic economy, which is in sharp contrast with consumer sentiment in the US, for example. So how do I play China? Currently, we are neutral. It's really a view that is, on the one hand, acknowledging the valuation opportunities and the potential support that could come from the central authorities, but on the other hand, just really recognizing structural challenges around growth headwind, demographic headwind. You know, we're expecting 3% growth for Chinese economy by the end of this decade. Maybe in the very, very near term, we have kind of policy measures stepping up, generating some sort of excitement, but the structural trend is hard to fight back, and this is why we are neutral.
So, Wei, I mean, is there a danger that we're actually exporting, I guess, deflation across the world? I don't know whether, when you look at the pattern of inflation, what kind of influence China will have.
Well, PPI has been very weak for a long time. CPI is starting to also be weak, which is certainly kind of linking into some of the channels that we're seeing for the rest of the world. You look at Eurozone inflation that has surprised on the downside for 3 consecutive months. I wouldn't say that 100% kind of linked, but certainly this disinflationary pressure that we see in China is impacting kind of the broader global economy as well. On the one hand, it makes the job of central banks a bit easier because they want to fight inflation, and this is kind of feeding into that. On the other hand, for domestic kind of economy in China, this inflation is a challenge, is a difficulty that they need to address. You know, inflation falling, nominal profits, nominal earnings will be impacted, which is also why sentiment towards China so far this year has been very negative, which is also why it's soliciting all this response from the central authorities. But do we have the bazooka that markets need to really turn around? Maybe not yet. We have had very targeted, steady drumbeat of targeted measures, but not the bazooka that we saw before.
Wait, I mean, the other thing that seems very exciting for next year is Japan. And I've seen more and more calls actually being positive on Japanese equities. I don't know how you play Japan, whether it's some kind of carry trade or whether you play it in relation to something, or you just go full in Japanese equities or else.
Well, we like Japanese equities. We upgraded it twice through the course of 2023, and we continue to have it as an overweight as we head into 2024. Earnings already have been revised higher. We think there is further upside even to the revised higher level. But of course, the risk here is that against the broader backdrop of developed market central banks talking about rate cuts, at least the Fed starting to talk about rate cuts, is there room for the Bank of Japan to exit it's very easy monetary policy. And when it does that within a short window, does that generate additional volatility? We like Japanese equities on a currency unhedged basis for precisely this reason, because we certainly see yen having room to strengthen as it tries to exit its very easy monetary policy environment when the rest of developed market central banks are moving in the direction of rate cuts. So we like Japanese equities, but definitely on an unhedged basis.
Thank you so much, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Now, coming up, Viktor Orban says he will not support a new aid package for Ukraine until the EU pays out all of the funds withheld from Hungary. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Now to geopolitics, and European Union leaders have failed to reach an agreement on a new financial aid package for Ukraine, which continues to be blocked by Hungary. But a significant political victory for Kyiv yesterday when the EU unexpectedly agreed to open membership talks.
We will revert to this matter early next year, and we will try to get unanimity in order to make possible for us to implement this enablement.
Well, for more on this, let's bring Bloomberg's Europe correspondent Maria Teresa. So, Maria, how significant are these two decisions for Ukraine?
Yes, Francina, these are two decisions that took place yesterday. Obviously, we know one went through and the other one did not. But to go back into what was agreed, and that is the accession talks for Ukraine. This was hugely important for the country. In fact, Francine, if you go back to 2022, when Russia invaded Ukraine, one of the first things that the government of President Zelensky did was to apply for EU membership just days after the war started. This is hugely important for the country. It obviously cements what the Ukrainian government says is a turn to the West that the country wants to make. Just to give you some color, however, and perhaps, look, this is the magic of Brussels and the way a deal comes through. But we are told that Prime Minister Viktor Orban of Hungary, of course, you know that he was very vocal about this idea that he does not believe Ukraine is ready to open accession talks. But at one point, he was told by the German Chancellor, if you don't agree in principle, we understand that, we get that, but now maybe it's time for you to leave the room and allow everyone else to vote in unanimity. So Viktor Orban, at that crunch moment, decided to leave. That's how this deal came about. When it comes to the funding for Ukraine, and that is the 50 billion euros pledged over a period of 4 years, there is no deal on that. We know the European leaders were working past 2 a.m. in the morning on this. There are still questions about how to present it and how to formulate this cash. And on top of this, Viktor Orban maintaining a veto on the money specifically. So no for the accession. That went through. But when it comes to the money, the Hungarian prime minister says he cannot agree to it fundamentally. The question is now, what happens next when it comes to the money for Ukraine?
All right, Maria, thanks so much. And of course, Ukraine saying they need urgent funds. Our European correspondent, Maria Tadeo, on this very, very important EU leader summit. Now, coming up, our exclusive conversation with the Campari Group chief executive on the largest deal in the Italian drinks makers' history. We'll talk, of course, about some of the things that he sees going forward. We'll talk cognac, we'll talk valuation, and we'll also talk about how our changing habits will continue after COVID. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So private sector activity in the euro area worsens at the end of the year, increasing the risk of a recession in the second half. Hungarian Prime Minister Viktor Orbán says his government will not support a new European Union aid package for Ukraine until the bloc pays out all of the funds it's withheld from Budapest. Plus, up next, our exclusive conversation with the Campari chief executive on the company's biggest ever deal. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a little bit of data. We're hot on data, actually, this week. This is on the back of what we heard from the ECB president yesterday, and so we're trying to piece together exactly what kind of inflation we'll be left with, what that means for growth, and therefore what that means for central bank policy. Now, Euro area December services PMI falling to 48.1. The forecast was of 49. So the latest for services, and then manufacturing is pretty much as expected, 44.2 instead of 44.6. We're also getting some UK PMI, so Euro area we had, so we're just reminding you what that figure looked like, euro dollar 109.63. And then the UK PMI is actually coming in, I think, as expected. Let's bring those numbers for you. If we have them, we should have them somewhere. We'll get back to UK PMIs. There you go. December manufacturing PMI, 46.4. The forecast was 47.5. Again, they're not great numbers because anything below 50 actually indicates a contraction, but 46.4 also missed economists' expectations. Now, Campari has agreed to buy Courvoisier Cognac from Beam Suntory for at least $1.2 billion. Now, the deal adds one of the major cognac brands to Campari's portfolio and is the largest acquisition in the Italian drinks makers' history. It comes as cognac makers face weakening sales, particularly from U.S. consumers after a surge in demand during the pandemic. Now, I'm now joined by Bob Kunze-Konzovitz. He's Campari's chief executive. Bob, first of all, congratulations on a big acquisition. If you look at the share price, there's a lot of question on what happens to it. I'm unclear to me why the share price is down 3%. But what do you think the biggest challenge with this acquisition is? Getting the U.S. to consume more or actually premiumize a lot of the brands?
Well, look, first of all, this is a one-in-a-lifetime opportunity to buy one of the big four maisons of cognac. I mean, this really comes around only every 50 to 60 years. It's a perfect fit with our strategy because we've always said we want to buy aged premium brown spirits with a skew to the U.S. and to Asia. And again, it is right out of our playbook, and this comes back to your question, is that we're pretty good at buying brands which have super latent brand equity, history, heritage, great liquids, but have been deprioritized and not really worked the right way by their previous owners. So we've shown time and time again that we're able to turn around those brands and get them growing again and premiumize them. Now, if you remember, you know, it's very similar to when we bought Wild Turkey. At that moment in time, in 2009, bourbon was really an unexciting place to be, but we really believed in its long-term opportunities, and we bought a brand which was dusty. We turned it around, premiumized it, sexy, and bourbon is now our second largest leg and doing extremely well, and it's one of the hottest categories in the market. So we see a lot of parallels. And last but not least, this is the right moment in the cognac cycle to make such an acquisition. I mean, it's much better than buying when you're at the peak or when the markets are frothy.
So, but you think you got a good price for it?
We think we got a pretty fair price for it, yes.
And Bob, just talk to me a little bit about
how long
the time.
Bear in mind the scarcity.
Talk to me a little bit about how long a time you think it takes to move consumers to premium offerings. So do you also have to age, or how much longer does a maturing liquor need to be laid down to get that premium price, or is it about marketing and selling it differently?
Yeah, the great news is that we're acquiring a fantastic inventory, which is very well balanced across the different types of liquids and age profile. So there's zero limitations from that standpoint. It's going to be much more of a marketing and a sales exercise, and this is our bread and butter.
Bob, talk to me a little bit about, the secret sauce of actually, again, premiumizing brands. I know it's collaborations. I know it's kind of also the cool effect. Is it harder now than it was in the past, or is it just the same pattern that you can repeat? You're also leaving in a couple of months. So what kind of advice do you give to the person that takes over?
Well, you know, in brown spirits, the secret is actually lies in innovation, and that's what we did with Wild Turkey. We really innovated up and stretched the brand. When we bought it, it was actually ending at $19.99, and now we're at $450. So if you have the liquid, in Wild Turkey it took a little bit longer because there wasn't much of an aged inventory. Here we have it, so we can act very, very quickly. But at the end of the day, what really counts also is having authentic brands, brands with history. I mean, this is one of the most awarded brands in the category. It's actually the most awarded one. And it is widely recognized for fantastic liquids. Now what we got to do is get liquid to lips and make the consumer dream about the brand again. With regards to advice to my successor, I mean...
Yeah, I was going to ask you.
Well, look, you know, the CEO is changing, but the team is the same. And the capacities and the capabilities we built over the years are there. So it's a very, very strong team. And we've really built a scalable model. The company is able to handle now a much, much larger and more complex, let's say, portfolio of brands. So we're in a very good position. You know, at the end of the day, our business is about brands and people, and it's people who build the brands. So really my advice is let's keep on, you know, that very strong Campari culture, the Camparistas motivated and really focused on the priorities.
Bob, talk to me a little bit about, I mean, you've seen Campari change in so many ways over the years. You also steered this group in the midst of COVID, where a lot of bars were locked down and you've had to repivot and rechange. Where do you think the biggest challenge will come from in the next couple of years?
Look, I think, first of all, we're very, very well positioned from a category standpoint. We're right in the hottest categories, in bourbon, in tequila, in the aperitifs, and we believe that, you know, as of next year, cognac is going to normalize and come back. So we're very well positioned from a category standpoint. Our marketing model is pretty unique. We got to make sure that we stay, obviously, always one step ahead of the competition. And we'll see, you know, the biggest question marks is always what's happening on the macro geopolitical level, and that is not anything we try and control. So I always tell our folks, you know, there's a lot of market share to be taken from competition, and just let's focus on that.
But, and I know we've spoken about supply chains, you know, even onshoring, friendshoring, whatever you want to call it. Is it getting easier for drinks companies?
Yes. I mean, we're back to normality. You know, during COVID, there was such an increase in demand that all of our brands were on allocation. Now, our supply chain colleagues have done miracles. You know, we've basically doubled or tripled our capacity across all of our core categories, and doing that, you know, whilst the plants were still running. It's almost like doing, you know, heart surgery while you're running a marathon. But they've done a great job at that, and we're in a perfect position. You know, a case in point, next year, Espolòn, our tequila, becomes a global priority because now finally we have more than enough liquid to go around on a global scale.
So as our tastes are changing, I don't know whether there's, you know, a higher spirit brand or spirit that you think will be the future as I guess we try and become more healthy, or actually our tastes are less sweet?
Well, look, over time, you know, the trend is very clear. People will drink less, but will drink better. And that means premiumization is the name of the game. And that's where, for example, an acquisition like Courvoisier comes into the game. If you look at the big trends, you either have the higher ABV classic cocktails or the single malts and the whiskeys and cognacs of this world, or you have the lighter ABV or no alcohol, and that's where we play with the aperitifs as well as the Crodino non-alcoholic aperitif brand.
And Bob, a final question maybe on where you see the biggest strength. I know you kind of track the economy in terms of people, feeling good enough to spend on drinks, either at home or in bars. We are going into the crucial Christmas season. When you look across the world, is the U.S. that much stronger, the U.S. consumer, compared to anywhere else?
Absolutely, absolutely, and particularly the on-premise, where we over-skew. So we're very happy on how we're trending in the U.S.
Thank you so much. As always, Bob Koncevitz, Chief Executive of Campari, stepping down in a couple of months, but he will come back on air to have a lengthy interview on how he sees the changing world, of course, of alcohol. Coming up, British Prime Minister Rishi Sunak heads to Rome to meet his Italian counterpart. We'll discuss the significance of the meeting. That's next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the British Prime Minister Rishi Sunak is staking his political future on a proposal to send refugees in the UK to Rwanda. This weekend, Sunak heads to Rome, where he'll meet his Italian counterpart, Giorgia Meloni, who has a similar plan to send as many as 36,000 migrants to Albania. Now, for more on this, I'm joined by Bloomberg's Alessandra Migliaccio in Rome. Alessandra, it's a pretty unlikely, I guess, friendship or closeness between the UK Prime Minister and the Italian Prime Minister. What are they actually, discussing? Is it to get something done in terms of business, or is it just to show Europe that they're allied on this?
Hello, Francine. Thank you for having me. Yes, I think definitely they're just trying to show a united front. I think they both need allies for different reasons. I think Rishi Sunak sort of needs to position himself a little bit more on the right just to get those extra votes, that extra consensus. And Meloni, on the other hand, ironically, just the other way, she needs to be more center-right because she's looking towards European elections next year. She wants to sort of be the leader of a kind of a center-right, so she's repositioning herself as palatable, as non-fascist, because as you know, at the beginning, she was seen as this very, very right-wing candidate, and the more she goes on in her presidency, the more she's presenting herself in that way. That said, this is a pretty crazy plan. Whether it's Rwanda or Albania, we don't even know if these plans are legal. We know that the courts, in both cases, different courts are opposed. So is this even feasible? We don't know, but it's something that politically is giving them extra points, let's put it that way.
So, I mean, this is a great point you make, right? This conference previously attracted hard right figures like Trump, Orban, Steve Bannon. So how much of a surprise is it that the Prime Minister of the UK is showing up?
Well, it is a surprise, really, and then it won't just be Rishi Sunak. It's a very interesting thing because we're also getting Elon Musk coming. She's invited kind of a very diverse bunch, and it's no longer this conference has been going on for at least 20 years, if not more. It's no longer that. It is now sort of more of a center-right event where she's also inviting members of the Italian opposition, and it's really, though, a way to sort of showcase her party, her power, her international clout, or what she perceives it or wants people to perceive it as. And it's just a way for her to position herself politically because there are European elections coming up, because she wants to increase her power base in Italy as well.
So, Alessandra, talk to us a little bit about the Albanian plan. I mean, how feasible is it, and what's being talked about in Italy?
So the Albanian plan is another crazy thing because why am I saying that? Because you would be taking, from what we understand, families off these ships. So in the sea, in the high seas, you will be separating families likely because it's not legal to take minors. Pregnant women would be separated, maybe all women even in some, depending how you interpret the law. So you'd be taking these men to Albania, separating them from their families, which again, possibly illegal, to where? To an enclave which would be run by Italians, but the security would be managed by Albanians. Again, is that legal? Albanian courts are saying perhaps not. Will it ever happen? We don't even know if this will ever really happen. But the announcement has gotten her a lot of brownie points, in Italy, in polls, and I think that's really what she's looking for. She's done this before. She's announced things that then never happened, but it's gotten attention.
Thank you so much, Alessandra Migliaccio there in Rome. Now, Bloomberg has also learned that Ethiopia's government is aiming to conclude a deal with bondholders early next year. This comes after it missed a $33 million interest payment on a euro bond earlier this week. Well, joining us now is Bloomberg's Ondiro Oganga. Ondiro, thank you for joining us. So first of all, how did Ethiopia actually get into this position?
That's an interesting question, Francine, because a couple of years back, Ethiopia was one of the most promising economies in Africa. And today they're where they are. Here are some of the things that led up to this. One, there was a civil war for 2 years leading up to November 2022 that claimed lives, affected livelihoods, and also negatively impacted investor perception and confidence in Ethiopia, a country that is in dire need of that kind of investment and perception. And again, there was also COVID-19, the immediate and aftermath effect. The economy is yet to recover. And finally, liquidity challenges. Businesses, both local and foreign, have spoken about the challenges that they have with access to foreign exchange, thus putting a strain on their day-to-day operations. All this took a toll on the government. They went to China. They said, can we get debt relief? Which China gladly obliged. And so the government sees that if we're not paying one creditor, it's only fair that we don't pay everybody. I mean, what's good for the goose is good for the gander.
So what happens if they actually fail to make that payment?
A couple of things will happen from this, Francine. One of the things that would happen is investor perception is further going to be negatively impacted. And this is not good because those who have their money there might think of getting it out, and those who wanted to invest there might hold on until they see how things go. This will put further strain on their constraints with FX, and also we are likely to see their currency maybe depreciate. We are highly likely to see inflation rising, and also the cost of living. Another thing that is likely to happen is lower credit rating. Already Fitch has said that if they don't honor their debt obligation by the end of their grace period, then they're going to be downgraded to restricted default.
And so how did the latest call with international bondholders actually play out?
Well, for once, they have good news. It went a little bit better than the previous call because the previous one with investors broke down. But this time around, we're understanding that they came close to concluding a deal early next year that will see the terms of restructuring the Eurobond of $1 billion come to a close. This is good news for them, but then again, it comes with its own set of challenges. Investors had issues with the technical nature of their payment, and also there were issues with the IMF program. The sooner they get it rolling, then the sooner they can have parameters of restructuring their debt. So this is something that we're just waiting to see how it unfolds, but hopefully next year we begin to see some movement.
Onjiro, thank you so much for joining us. Onjiro Ganga there in Kigali. Now, coming up, China's central bank offers a record $112 billion of loans to commercial lenders, just as economic data from Beijing comes in mixed. So we'll have all of the details next. And this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
As I've said before, America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country. I and other U.S. officials have repeatedly stated that the United States does not seek to decouple from China. This would be damaging to both our economies and would have negative global repercussions.
Well, that was U.S. Treasury Secretary Janet Yellen, who says she plans to visit China again next year. Well, this morning we have had data out of China showing industrial production beat expectations, but retail sales fell short, putting more pressure on Beijing to boost growth. Meanwhile, the PBOC has also offered a record cash injection via its medium-term lending facility. Well, joining us for more is Bloomberg's Sofia Orta Acosta. Thank you, Sofia. It's been too long, actually, since I've quizzed you about China, because you understand it like no one else. What are your key takeaways from this China data dump?
So a little bit of a mixed bag when it comes to economic data. I am looking at retail sales, though. That miss there is important because even though consumption is not a huge chunk of the Chinese economy, it's where the problem really is. It shows weak domestic demand, falling short of estimates really shows also why there's a deflationary problem in China, really the opposite problem of most economies in the world. CPI, the data that was out a few days ago also showed, it's negative territory, really a problem there, and that Beijing is struggling to revive confidence, revive spending. And what I'm looking at is, it's a bit tricky, I think, because whenever you look at this economic data, the weaknesses, the pockets of weaknesses there, Beijing doesn't really have that many tools to address this right now. And we're looking at, Francine, you mentioned the MLF, the medium-term lending facility. Well, that actually is China almost recycling money throughout the financial system because it's feeding money into the banking system. Banks then use this money not necessarily to lend, because that would be good for the economy, but actually to buy government bonds. They're the biggest buyers of government bonds, and then that's used for fiscal stimulus. So it's almost like the government lending to itself in a kind of circular way. And we saw very weak credit growth data earlier this week. So there's clearly not demand from households and corporates to borrow. So we're in this problem. I mean, I do think the new state does show some resolve from Beijing to address this problem, but it also shows that the problem is perhaps more severe than feared.
All right. Thank you so much, of course, Sophia Ortega-Costa. We're just getting some breaking news, actually, from the Hong Kong Exchange, naming Bonnie Chan as a chief executive, replacing the former chief executive. So we'll try and dig a little deeper into what Bonnie Chan has been doing, if they've also said anything to do with the exchange, possibly how they also want to maybe change some of the way they operated. Just 2 days ago, we had a great conversation with the NASDAQ co-president to have an idea of what he was going into, now really saying that he wants to be seen as a technology company instead of just an asset or transactionary kind of company. Up next, Bloomberg Brief. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The Fed's pivot ignites a blistering rally in treasuries and pushes stocks towards all-time highs. China's central bank ramps up support as fresh data confirms patchy recovery for the world's second biggest economy. And Costco continues to show resilience as big retailers voice caution on the consumer outlook. A very good day to you. It was a slow drift into the Fed pivot, but wow, higher for longer has been supplanted by higher for shorter. This is the ETF of the longer end of the curve. Big shout out to Danny Berger. This is her fact of the day. This has returned 5% over 2 days. Far too intellectual for me on a Friday morning, but it gives you a sense of the real belief by the long end of the curve that the Fed will indeed re-grasp the inflation narrative or not. So it's the best return since March 2020 over 2 days. I haven't got any long treasuries. Let's talk about that. The Fed's munificence, it really has paid off. And to that end, you're seeing a little bit given back. 10-year treasuries were down by 18 basis points yesterday. So that's a real driver there. Gundlach's 3% call looks ever so much more real because in the past 4 recessions, what you've seen, 200 basis points of cuts from peak to trough. So is there still mileage in the 10-year government bond rally that you've seen? Crude is managing to eke out a gain this morning, up 0.3%. It is the first week of gains in the oil market. We've broken that doom loop that we were on of 7 weeks of losses in the oil market. You've got the bullish report from OPEC that there will be deficits in the first quarter, but the IEA has slashed their demand growth, Danny, by 400,000. But crude managing to rally. The dollar's obviously on that downtrend. Dollar yen, I mean, they must be just so thankful across at the Bank of Japan because what you've got there is dollar down, yen rallying. It's on a rampage. The best 3 days for yen since March of this year. So that gratitude at the Bank of Japan is there. By the way, be a little bit wary. The greed index on yen, it has hit the highest level since 2009. Fear and greed. Fear and greed.
It feels appropriate around Christmas time to be a little bit greedy to get those presents in. We're greedy maybe on this equity market. We're only now 2% from an all-time high in the S&P 500. We go higher again this morning. We're up in the future session by about a third, but we've already seen record highs from Manus's favorite index, the Dow. We've seen it from the S&P Total Return Index, and the FANG Index has also hit a new time high. Hang Seng not to be left out of this global rally. This thing is up more than 2 1/3%. China injecting a record amount of cash into the economy. It is big measure stimulus, something that we had been waiting for after the piecemeal. But the data was bad in China this morning. We overlooked that as we were overlooking the poor European data. PMIs came in at 47. They're in contraction. They're down for a 7th month. The expectation would be that they would gain. So the data looks kind of recessionary in Europe too, but now more cuts are being priced in. Therefore, equities can rally. And Manus, I think one of the best encapsulations of this about-face we've done in markets is small caps. If you look at the Russell 2000, specifically the ETF for it, this is from Bespoke. Just 48 days ago, it hit a 52-week low. Now, if you look at that at the moment, we are at a 52-week high. That is the quickest turnaround, Manus, for this index since the 1970s.
Well, that is, I mean, you're just piling out the facts today. You're on fire this morning. I got to say,
too much Excel today.
You're just banging them out. I mean, the Bank of America, I think the flow show as well very much reinforces the narrative that you've just expounded there, because what you've got is money market saw the first outflows in 8 weeks. And the flip side of that was that equities had their largest inflows in 8 weeks. Now, I'm not saying that the $5.9 trillion that's sitting in money market funds is going to all of a sudden go of a gusher into equities.
Right.
Maybe it takes 2-3 rate cuts to get people to pull a significant proportion of the money market funds out, so it's not a one-way gusher tap. Good morning. Happy Friday. We got there. Woo!
We did. We got there. Nothing broke. Everything seems sunny and joyful, but can it stay that way? Let's kind of dig into these themes, Manus. Joining us now is Megan Brennan, Portfolio Manager at Saracen and Partners. It's clear there's a lot of euphoria in this market, Megan. Do you want to ride that euphoria, or has it gone too far?
Yes, I think the market moved very quickly this week to price a March rate cut by the Fed. We're certainly in the soft landing camp. If you look at core PCE inflation, the Fed's preferred measure, we're basically within target. And we're also seeing the employment market still very strong. Consumer spending is strong. We saw the data for that in the US yesterday. So we think that there is definitely an economic slowdown, and that's needed to bring down inflation, particularly wage growth. But as you say, it looks optimistic.
Yeah. Megan, good to have you in this morning. So, the Fed says 75 basis points. The market wants 150 basis points, or is betting on 150 basis points. And if you're a real bull, you're 275 basis points. So Danny and I had a conversation this morning. What is the number of rate cuts? Is it 150 basis points that says inflation is in check, things are in good order, soft landing? Or should I be more concerned if it is 150 basis points, because that is a flashing red signal to something more malevolent on the macro front?
I think we're more in the 150 basis points camp because wage growth is still sticky, and also the shelter component of inflation naturally operates with a lag. So we will see that to come down, but we think we're more in the April camp for a rate cut than the March one.
Yeah, and we just got, the Atlanta Fed wage tracker yesterday for November, 5%. So that definitely backs up what you're saying. But it is interesting because among this market happiness, you see this big loosening of financial conditions, whether it's the stock market rally, whether it's long bonds. Chair Powell not that long ago said that tighter conditions meant that he didn't need to hike as much. Is the opposite true for looser conditions? If the market is rallying, do they not need to cut as much?
I think so, and I think that we've seen also with the ECB and the Bank of England being very cautious on prematurely loosening monetary conditions before they have really tamed that inflation beast. So I think you're absolutely right. The market is doing part of Powell's job for him. We've seen the US 10-year come down below 4% now for the first time since July. So there's definitely an element of that, and that's certainly part of the tightrope that central bankers are having to walk at the moment.
I mean, in many ways, this melt-up, this risk-on narrative that we've seen across markets is predicated on something much deeper in terms of the target on the 10-year. You've got Gundlach talking about 200 basis points of cuts and 3% on 10 years. You've got Bill Gross saying that's farcical. But the momentum that you're seeing in these markets, is there any sense of exhaustion in terms of the market was so long into this Fed decision, or have the markets got the capacity to get to 3% and take out the record highs in equities and the lower bound in treasuries?
Well, I think you need to look at the components of the market. I mean, certainly yesterday we saw a rotation out of the into the laggards and out of the winners this year. But if you look at the, say, S&P 500, it's been very narrowly led by the so-called Magnificent Seven for most of this year. So I think looser financial conditions certainly have the potential to improve the potential for those outside of the narrow market leaders next year.
So if we feed the ECB's decision into this, after a decision where Lagarde certainly pushed back more than Powell, expectations for rate cuts, they're a little bit different, but basically dead even as to extent and when they start. Does that make sense to you, given this morning's data on PMIs for Europe, given where inflation is? Do you think the Fed and the ECB will look similar in 2024?
I think so, and we actually assumed that the ECB cut in April, but Christine Lagarde has a very difficult position in that wage growth in Europe is still very sticky, but we've also seen a very uneven recovery post-COVID in Europe. German manufacturing, as we've seen, is potentially impaired over the long term from higher energy prices, higher wages, and has become somewhat uncompetitive in certain areas of the market. So I think that there are also some parts of the European inflation complex that we need to keep an eye on. The deflation or disinflation that will be imported from China into, say, Germany next year will fall. And also there are things like carbon pricing, which have upward pressure on European inflation. So the mix and the control levers there are quite different in some respects.
Yeah, no, good point. Manus.
There's a real determination by China to reignite the spirits of optimism. They promised us 5% growth for this year. They've just injected the largest amount of money into the system in one-year loans. So we've got that, and we've also got this commitment to run a budget deficit above 3%. Is that a healthy stimulus mix or toxic?
I think there's certainly a lot of unproductive capital that is at work there, but we think they will hit that 5% growth target by infrastructure spending and other growth measures. But if you look at the inflation data last week and then the consumer confidence and spending data this week, it's clear that they have to do something. And the CCP and the PBOC are in a slightly different place than the ECB in that they have balance sheet capacity to absorb problems in, say, the property market.
Yeah, well, it's circular absorption, isn't it? Yeah, they haven't joined the pivot party, but then neither the ECB or the Bank of England. Megan, thank you very much for joining us. That's Megan Brennan.
Thank you.
Saracen and Partners, our guest this morning on the big topics of the day. Other stories that are trending on your Bloomberg terminal this Friday morning. The Treasury Secretary Janet Yellen says she plans to visit China again next year and wants to focus on what she calls the difficult areas of concern. Yellen spoke at the US-China business event.
As I've said before, America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country. I and other U.S. officials have repeatedly stated that the United States does not seek to decouple from China. This would be damaging to both our economies and would have negative global repercussions.
GM is cutting more than 1,300 hourly jobs at a pair of plants in Michigan. It comes less than a month after a labor contract was ratified by its unionized workforce. The staff reductions are effective at the start of the next year.
Victories, big and small, they keep piling up for Argentina's new president days after debuting a tough love plan that calls for a radical remake of the economy. Javier Milei says to have scored a vote of confidence. Who from? Goldman Sachs, the bank's recommending the country's bonds.
Well, coming up in one of the most dramatic moves yet by Citi, more banking stories for you, Manis. It's shutting down one of the businesses that was the envy of all rivals. We'll talk about that next.
And later this hour, we'll get an outlook for the emerging markets from Phoenix Kalen of SocGen. China's economy weakens further, stimulus abound. Her take on Argentina and beyond with SocGen.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
It's Bloomberg Brief. Danny Berger in London, Manish Cranny in New York. City Manus, they're shutting down its municipal business as it tumbles in rankings for underwriting state and local debt. It's the latest and most dramatic move in CEO Jane Fraser's overhaul of the lender. The firm telling its staff in a memo that the business is, quote, no longer viable given our commitment to increase the firm's overall returns. Joining us to discuss this is Bloomberg's Leo Kane-Sherper. Leo, I feel like we have you on basically every other day to talk about some restructuring that Citi is doing. How does this fit into the overall context?
Yes, exactly. So, first of all, it's not entirely unexpected. Our colleagues have reported this last month. Actually, now it actually happened. I think it's just important to stress how storied the business actually is, the Muni business. I mean, you know, they've been involved in the underwriting of the rebuilding of World Trade Center. They trace their roots back to the Solomon Brothers. So I think it's definitely a high-profile exit here. Of course, I think the broader strategy of Jane Fraser is really to cater to large multinational corporations, and I think that's where they didn't fit in anymore, and that's and hence the move.
Well, look, I mean, the other thing that caught our eye, and I think this is pretty amazing, this is all about Apollo moving into retail. It's not pure retail, but it is a credit product. I think you've got to have $1 million, and it can't include your house in your net worth. But you can get into Apollo's credit products for $2,500 now. So what exactly is it?
Yes, exactly. So basically they're giving investors in this new credit product exposure into their asset-backed loans. They're backed by mortgages, by auto loans. And those loans are originated by Apollo themselves. And as you said, $2,500 sounds okay, sounds accessible, but you have to have made, I think, 200K over the past 2 years, or each of the past 2 years, and definitely have to have, as you said, have to have a net worth of more than $1 million, excluding your primary home.
Not counting your primary home. Ooh. I mean, I think they'd probably be really upset if we said they're going into retail. Do you think we'll get an IB go, we're not going into retail?
No, I think these private capital people want to have this more friendly face to retail, and this is my segue of having a more friendly face. You know, there's that meme of like a poodle in a silly outfit being like, oh, my ancestors were wolves, and now I'm like a poodle in a silly outfit.
There's a lot
I feel
of them
like
in New
that's
York.
what's happened to private capital. That it's like their ancestors were the barbarians at the gate, and now they're poodles in silly outfits. Because I want to take a look at some of their holiday videos. Apollo has one that features Torsten Slok as an elf. I want to know, did Torsten lose a bet? I think we might have some sound on this to listen in. I'm not quite sure, but like I get really secondhand embarrassment from this.
I mean, this.
Okay, no sound on it, man.
There's no sound on this. This is just so. This is the ability to have a really good laugh at yourself. It really is. I mean, who in the name would wear an? Well, it's what you get me to wear. You would get me to wear an elf's costume and run up and down the newsroom.
Yeah.
I wouldn't have any objection
That
to
would
that.
be lovely.
But you know what? It just
some
shows
of the lines in this, because we can't hear it.
Yeah.
Can I just tell you, Manus, they say, here's some lines from it. Let's syndicate some spirit, and we have gingerbread houses, and that's one sweet asset.
Well, listen, you know, there you go. That elf run will stay with me forever. Let's pivot across from we are not, you know, this is brilliant. You know, we're not BlackRock. Now, who said that? Blackstone's holiday video. This just defies all belief. I sent this to a couple of people yesterday. It's
Not to be confused.
I want that coat. I want Schwartzman's coat. Listen to this.
Oh. Is this the end of capitalism? Leo, come on, you can't watch that and not get like a little bit of secondhand embarrassment.
Yes, no, definitely. I had some of that, and yeah, I think you know, I feel for the corporate affairs head who's basically said, for once, it would be nice to be mistaken for BlackRock. So I can feel them there.
You know, I have have to say, I don't know if either of you have watched the full video. It starts with a skit that's kind of a parody of The Office. It's actually funny. Like it is. I actually did laugh when it got to the song. I was like, oh, I don't know. But the start of it, I actually recommend to watch this one. It actually is kind of funny.
I gotta say, the Blackstone one certainly takes out the Apollo one, you know, in terms of impact. So marks out of 10 for the comms and marketing team at Apollo. Danny?
I mean, I want them to keep talking to us.
Of course she wants the next interview. That's all she wants. I say 10 out of 10 to everybody because it's got the whole market talking about it. It's got everybody looking at it. And I suppose in that respect, they get the oxygen, don't they?
Yeah, Leo, it's some free advertising for them, isn't it? We just played them both.
I'd give them $600 billion out of $1 trillion target for 2026.
I'll give Apollo $2,500. There you go. Leo.
There you go.
There you go. I'm sold. I'm completely sold. I want to give my money to a dancing Torsten Slock in a leprechaun uniform. Okay, or a Santa's helper's uniform, not a leprechaun uniform. It's not St. Patrick's Day yet. Leo, well done. You braved it. You survived it. Leo Kane, Sherpa. A quick snapshot of commodities, something much more dry and sober for you. Crude's up 0.5%. You break the trend of 7 weeks of losses. The dollar drops and commodities rock. Good morning from New York and London.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Brief. It's your Friday edition from New York and London with Danny Berger and me, Menace Cranny. Now, I arrived 3 months ago, and I told you it was going to be peak peak rent. And we actually did a video to that extent. And it's been proven out. We're just looking at some of the data, Danny. Rents have dropped by 9% since I arrived. By the way, it should just be said that these are brownstones. So whatever you think about the rent of what I'm living in, A, it wasn't Sotheby's that rented it to me. B, I'm not in a brownstone. And C, we're talking about your average boxed rent. That's not where I'm living. Let's just reaffirm that.
Yeah, we're saying to our producer, probably more accurate to get videos of like a small box somewhere with like a mouse running through it or something like that. Maybe that's more commiserate with what we're looking at. Manus, I love this. I'm making the move to New York. I mean, so kind of the rental market to drop in anticipation of me. The one thing I will say, I'm a little bit worried because in this Bloomberg story, they spoke to the president of Miller Samuel, who said he doesn't anticipate a sharp correction, and then costs will start to rise moderately again during the more expensive spring and summer season. So yeah, optimistic now, but I know I need to move quickly or else I'm going to get in the expensive season. It's not going to play out in my favor.
Well, vacancy rates are up. Vacancy rates rose for the 14th consecutive month, reaching just under 3%. Danny, we can always send you to Queens. It is the closest to Manhattan. The median rent year over year fell for the first time in 11 months. If you go to Brooklyn, it's going to be a little bit more expensive. You know, just depends how quickly you want to be with me in the morning at 2:45.
I mean, getting in at 2:45 minutes, I'm surprised you don't just like sleep in the office under the desk because anywhere is too far from the office at that time of the morning.
You can never be too far from the office at that time of the morning. You want to get in, log on, eyes down, and prepare. That's what we've got.
Exactly.
Anyway, welcome to New York when you get here.
It's how the sausage is made, folks, on this show. Okay, coming up, we're going to talk EM with SocGen with Phoenix Caleb.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Manus Cranney in New York.
And I'm Danny Berger in London. Here's what you need to know. The Fed's pivot ignites a blistering rally in treasuries and pushes stocks towards all-time highs. China's central bank ramps up support as fresh data confirms a patchy recovery for the world's second biggest economy. And Costco continues to show resilience as big retailers voice caution on the consumer outlook. Caution, whatever. This market is throwing that to the wind. We are just now 2% from an all-time high for this American equity market. U.S. futures are up another third of 1%. Already at a new high, though. It's the Dow, it's the S&P total return, and the FANG index. We've also seen this huge return in small caps, the biggest reversal in fortune since the 1970s. Hang Seng not to be left out of the rally because of the stimulus coming from China. And we're going to talk to our guest about this very shortly. Hang Seng rallies 2 1/3%. Finally, European stocks on track for their 5th consecutive weekly gain. They are up 0.5% in the session so far this morning, Manus. Even though we had weak European data come out, at this moment, the bad news is just good news because it means that the cut and pivot party can continue on.
Yeah, even though Lagarde really pushed back quite aggressively, that French data this morning may well shift the narrative. You're not wrong to front-run the Fed. That's the message from Stephen Major at HSBC. And nowhere is that more resplendent than at the long end. So we've got the TLT. This is the ETF for you at the long end of the curve. It's blistering, it's blinding, it's whatever superlative you want. Danny's fact of the day, she created this fact. 5% return over 2 days. The best 2-day return on the long end of the curve. You've got yields ticking ever so slightly lower this morning, but you've got the best return since March 2020 on the very, very long end. So what does that say? That's a belief in the cuts, a belief in the inflation narrative. This morning on the 10-year paper, we've done our MLive survey of 190 respondents. They think we're probably going to end next year around 3.8%. So nowhere near Gundlach's call of 3%. We've got yields ticking down ever so slightly. I mean, the Fed's power put, the firepower of the Fed, as Apollo said just a couple of weeks ago when we were in their office, is very, very clear. And that's what's coming to bear in the bond market. So higher for longer has been supplanted for higher for shorter. And in terms of the crude market, you've got a break of trend there. We had 7 weeks of losses. We've managed to turn the corner on that. The IEA data supports the market. The dollar is dropping as well. There's a drop in demand from the IEA. They're cutting their demand outlook for next year. That is also a facet in there. Dolly, they must be so relieved at the Bank of Japan that this sort of Fed pivot is active live. It's just a debate now of when it will happen. It gives them a little bit more room, but the greed index on the yen is the highest since 2009. So, Danny, you know, they may have a sense of relief at the Bank of Japan, but now it's down to delivery from the Fed. Let's see what the Bank of Japan say next week, because they are in play. You'll handle that. I will be somewhere far away.
Oh, yeah, that's right. You're going to leave me on my own on
it's the first break in 3 months. Thank you. It's the first break in 3 months.
Okay.
Every day.
Okay, fine. We'll give it to you. Manus, you know what else is having a break? Here's my little market segue. Cash. Yeah. We were just talking about the Flow Show during the break. I do have the data, not from the Flow Show, but from a different outlet, saying that money market funds fell from a record high. It's the first decline in money market fund assets in 8 weeks. And Manus, of course, the question is if it's coming off the sidelines, where does it go? Which of these markets benefits? Well,
I mean, there's 5.9 trillion in the money market funds, up 25% on the year. We're divinity. We read the same piece of paper and some of it sticks. But of course, it was the best inflows to equities. I think if we're on the same sheet, it was the best inflows into equities in 8 weeks. So it's the beginning of that turn. Or as I said to you at the start of the show, which is, do you need to see delivery on those rate cuts of 2, 3, maybe 4 rate cuts before there is a massive vault out of cash into equities? Are we at the beginning of the front running of that?
Although Michael Hartnett from Bank of America does warn that history shows that it doesn't automatically mean further gains for risk assets if cash outflows continue. But let's turn to where the cash is flowing. It's China, Manus. It's a policy combo coming from the PBOC, injecting record amount of cash into the economy as the latest data shows a weaker recovery. Let's bring in now Bloomberg's Sofia Orta y Costa. Let's start with the data that we got. What were the big picture takeaways from it, from the economic picture we're seeing in China?
So I know you don't like this answer, but it was a bit of a mixed bag.
I should just expect this for every answer now when I ask about China data.
So essentially, industrial production was a little bit better for November. That's the good news. The bad news, and I think the more important news actually, was retail sales falling short. And that's important because we did get data, inflation data out of China that showed China has a much worse deflationary problem than perhaps we thought. And this reflects low domestic demand. Beijing has really been trying to ramp this up because what's happening is a kind of move away from manufacturing and also the property market because there's such a severe downturn there. And what can replace this? It's consumption, but that's not working either. So I think for the big takeaway is, there's still a lot of work to be done. But the picture, in terms of reviving domestic demand, I don't think Beijing has a lot of policy tools left. Of course, this was data for November, still a little bit backward looking, but it does kind of set us up for an interesting 2024.
Sophia Orta-Acosta, you know that mixed bag is a crime against Bloomberg brief. It's a bit like on this team, I sent you an email, I go, that is a crime against communication. Call me. What about the quality of this stimulus? I mean, this quality of the stimulus is more about liquidity for the corporate, for the government, for the state-owned enterprises, relative to a boost to real demand. And that is the conundrum, isn't it?
That's a really, really good way to put it, actually, Manus. And you saw that today, and I think this feeds into that theme, that the central bank is pumping liquidity into the financial system. I kind of just want to de-geek that a little bit. What that essentially means is that the central bank is offering cheap loans to banks. These banks then use those loans not to lend into the real economy, Manus, and that's really what would move the needle, what would make a difference in reviving this domestic demand. But they're using those funds to buy government bonds. And this is because Chinese banks are the biggest buyers of government bonds in the primary market, and Beijing is selling more of these bonds to be able to fund the fiscal stimulus that is widely expected next year. So it's essentially a recycling of money through the financial system for this fiscal stimulus to be able to take place. But the question is, when you see a really kind of weak credit data that we got earlier this week, is any of that actually making its way into the real economy to get household spending, to get corporates, hiring? There's still an unemployment problem and a really kind of big policy transmission mechanism problem there. I think you really nailed it there, Manus.
It's not often I nail many things on this show, Sophia.
It's because you accused her of committing a crime, Manus. She wants to stay on Bloomberg Brief. Well, we do too, to be fair, but
You're our star. You are our star. You are our North Star on China. And by the way, she'll be off doing a TikTok now on something that you just said during that report. We'll come back to that in a moment. She's a big star on TikTok now. She's in the ascendant. Right, Sophia.
Me?
No, well, both of you are. I know that. I've got a lot of competition. I just sort of drift along on Instagram kind of thing.
Get on the TikTok, Manus.
Falling in and out of Lamborghinis, as you do. Sophia, thank you very much, Sophia Orta-Acosta, on the China policy response. Let's broaden the conversation from China to broader emerging markets. Joining us now is Phoenix Kalen, Global Head of EM Research over at SocGen. Great to have you with us, Kalen. First of all, the quality of the response of the biggest cash injection ever, $112 billion in one-year loans. Is that the kind of response mechanism from the PBOC that would engender a sense of let's expand our exposure to China? Good morning.
Yeah, no, I think this is exactly what the market is looking for, is a step up in the response. We haven't seen that so far over the past couple of years. It's been kind of a drip feed, IV drip feed of policy measures, and it's been very incremental. So this marks a departure in terms of the size of the response, and it really shows they're recognizing that much more needs to be done to stabilize growth, and you just can't let that go.
I gotta say, Phoenix, I feel so bad for you and your peers and your colleague, basically anyone that has to put out a target now for 2024, because this month has just been so crazy and upending all the narratives. When it comes to this China narrative, I know you and the team are short CNH Korean won, and one of the risks you point out was more aggressive downside should the PBOC inject more stimulus. Does that meet that bar that perhaps you want to be even shorter on your target for you won basically any cross there?
Yeah, I mean, we're still constructive on the relative value plays between Korea, being long Korea, versus some of the other Asian currencies like CNH, like Taiwan dollar, for instance. I think overall the fundamentals are still much weaker coming out of China. The policy response, we are seeing that emerge, but that will take time. And we haven't seen kind of the sizes that are necessary to actually put a big dent into what's happening there and really revive consumer confidence, especially around the housing market. So I think it's still, the market has overreacted, as it likes to do from time to time. So, but I think in terms of the relative value proposition, the carry trades and the kind of the more market-sensitive currencies like Korean won, like a lot of the carry plays in LATAM or in CEMEA, those are likely to do much better than the low carry players.
I'm literally just running WCRS to see what the best performing emerging market currency was of 2023. Colombian peso, Mexican peso, and the Polish zloty were the strongest. Now, given the Fed's pivot, are you a believer that the dollar's position relative to EM, this is the great debate, isn't it? The dollar will move, the theory is a soft landing, and that could probably be a bearish signal for the dollar. So within EM, what is your base case for the currencies broadly post the Fed's acknowledgement yesterday that they are talking about cuts?
Yeah, I mean, the story around emerging markets has become much more one-dimensional these days. It's basically a macro play on the U.S. It's if we're looking at, let's say, the 6-month correlation between EMFX performance and the dollar index, for instance, that's 95%. It's negative 95%. So it's basically just reflecting what's happening out of the U.S. dynamics. And so for us, yes, we are expecting for the dollar to continue to fall on the story around Fed pivot, on the story around monetary policy divergence now, with the Fed set to ease. And so we're expecting for the dollar index to fall down toward 97 by the end of next year. So that's, I mean, because of how much the market has moved already, that's only about 5% from here. And that is implying around a 2 to 3% gain for EMFX spot returns, which is not that much because of how fast and furious the reaction has been.
We also had a whole lot of EM rate decisions, too. And it does feel like the Fed sort of set the tone and expectations for how dovish banks would go. On that front, Phoenix, it does seem like there was some disappointment. Mexico, folks have been looking for a dovish shift. We didn't get that. Brazil cut by 50 and said they're going to stay there. Markets also thought maybe they'll start saying they'll go by 75 basis points. Do we make a mistake if we extrapolate the dovish pivot from the Fed to some of these LATAM banks?
I think that is definitely a mistake that the market should be very concerned about, because the central banks in emerging markets have had this story around trying to tackle inflation for the past several years. It's been very tough. They are making so much progress now. They don't want to jeopardize that progress and undo the credibility that they've built up over the past couple of years, and kind of have that feed through to higher inflation, higher inflation expectations, into a weaker currency. They don't want to do any of that. So I think the central banks in EM are going to sacrifice a certain amount of growth in order to keep the currency stable, in order to protect financial stability. And that is, to some extent, going to keep those currencies a bit more resilient than the market might think.
And Phoenix, just quickly before we let you go, there was an election in Argentina very recently that shook things up. There are 5 more LATAM elections in 2024. There are even more elections when you look at the broad space of EM. Are markets discounting enough political risk at this juncture, do you think?
I think the market is really complacent on political risk and on geopolitical risk. I think that will become a much more powerful story come kind of May, June, middle of next year, as we see the U.S. elections play out in particular, and how that is going to shape, the dynamics around what happens to the dollar. If the various polls show, for instance, Trump coming back, for instance. So I think the market is not thinking about that at this point, is still on this sugar rush around the Fed pivot and around some of the stimulus measures coming out of China. And for the time being, we would expect for that kind of wave to continue for the next couple of months, for the rally to persist, because there is still scope for a lot of the rates markets to rally. there is still scope for a little bit more currency gains. And so let's enjoy it while it lasts.
You're right. Enjoy it while it lasts, because it certainly will not be a one-way trip in any of these markets for 2024. We wish you well. Thanks for joining us in 2023. We look forward to joining us on some of those election dates next year. Our guest on the markets there. Sticking with the global picture, the US Senate will delay its holiday break and return to Washington next week to try and strike a deal on aid for Ukraine. Meanwhile, the EU was unable to agree on any financial aid for the country during their meeting in Brussels. So we have a massive impasse. Maria Tadeo is reporting on this. Maria, Ukraine says it urgently needs the funding. Can the EU still deliver? I mean, this is we're turning this into a crisis now. Both the US and the EU seem to be pulling up the drawbridge.
Yeah, and of course, and when you talk to Ukrainian officials, what they say is their prerogative has not changed. They need funding and they need weapons. They need it soon. And if you listen to Vladimir Putin yesterday in that press conference, that sounded like a man who now believes it is Russia that's winning and he's got the upper hand. A lot of that, of course, going into a U.S. election year. And now there's clear, proven evidence that there is an element of fatigue when it comes to the funding. Now, just to be perhaps a bit more nuanced on the European perspective when it comes to their funding. Remember, the EU promised Ukraine they would get 50 billion euros over a period of 4 years. That was not the case yesterday. There was not a deal. There was not an agreement. A lot of that sidelined by the Hungarian Prime Minister Viktor Orban, but we are being told nonetheless that a deal for 26 out of the 27 EU member states was agreed. The issue now remains Viktor Orban, but the EU believes when they meet again, and we now know they will meet again in January, they can get to a deal to facilitate the 50 billion euros. So they're actually more optimistic when you speak to them behind the scenes.
Yeah, when they reconvene today. So let's see where that goes. And there's been quite a few issues, obviously, with Hungary over this. Maria, thank you very much. Great reporting. Maria Tadeo there in Brussels. Danny and I will take you through the deals at Costco for Christmas. That's next.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
The reception, the acceptance of Purosangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
You're watching Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Manus, I have an important question for you. You're in America now. Have you been to a Costco?
No, but I am looking at the website, and I have been to Best Buy. I mean, I'm a broad church. I'm everything from
They're so different.
Saks, Bloomingdale.
So different.
But
Okay,
Best
here's
Buy.
the thing with Costco, Manus. You need a membership, so when I get there, I'm taking you to Costco, we're having a party, we're eating all the samples, but clearly it's not just me that's very excited about Costco, because in the pre-market trade, it is getting a lift up 1.5%. The warehouse club chain continued a string of strong results. It announced a special dividend of $15 a share, while also posting profit that beat estimates. Joining us now is Bloomberg Consumer Goods reporter Dasha Afanasieva. Dasha, surely you've been to a Costco, no?
I have in Nottingham in the Midlands.
Okay, there we go. So you know Costco very well. What's behind the strong performance of them?
I think it's really the consumer wanting a really good bargain, because we know Costco is the space where you get really good prices, and you might not get exactly the brand that you want and the product that you normally buy, but they have, products that they can shift quickly, so they don't have high inventory and they don't have to pay for that, and they tend to be at pretty low prices. And I think with the cost of living squeeze, that's what consumers are looking for, particularly in the run-up to Christmas. And that's been reflected in the strong share price performance since around 2019.
And certainly, the one thing, living here, okay, I haven't been to Costco, but what I didn't realize was that Trader Joe's was actually bought by and owned by Aldi. And so if you look at the comparative pricing, yes, Whole Foods, whole paycheck, versus perhaps that buying power that things like Trader Joe's have. Let's pivot to H&M. Again, there's cracks of certain parts of the consumer under pressure. The very, very high end, we know, are seeing slippage as well. But at Hennes, we've also got sales growth dissipating ever so slightly. How much did sales fall by, and why are they struggling? Because surely I would think in a harder time I'd go to them.
So sales in local currencies fell 4%, and if you strip out the Russia and Belarus business, it was actually a 1% fall, which isn't quite as bad, but it reflects the increased competition in this area, because there are a lot of fast fashion players. When H&M first came on the scene, when Inditex first came on the scene, it was really novel that you get kind of 2-week lead time and you can copy things that are fashionable. Now you have the likes of Cider, Boohoo, you have Shein, which is going to IPO soon, and they're all competing in the space. So the challenge is really differentiation.
Yep, and certainly the high street is crowded. It's sort of mirror images when you walk around. It is a crowded place, and people are bargain hunting. There's no doubt about it. Okay, Dasha, thank you so much. Dasha Afanasieva joining us there for the very latest on the retail front. Coming up, Danielle and I will take you through market-moving events for the day. If you haven't had enough this week, we can serve you a little bit more.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've
made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
It's Bloomberg Brief on this Friday morning. I'm Danny Berger in London. Manus Cranny is in New York. All right, let's get you set up for your Friday, for your trading day. The Empire manufacturing numbers come out at 8:30 a.m. Eastern. That will be followed by U.S. industrial production at 9:15, plus PMIs at 9:45. We also have a full list of ECB speakers throughout the day. That includes Centennial's press conference in Portugal. And then, just because we have to, looking ahead to next week, Manus, it's the BOJ's turn with its rate decision coming on Tuesday. First, we had all this excitement. Ooh, maybe they'll end negative policy. But the current mood music is they're not in any rush to do that.
No, and there must be, a sigh of relief over at the Bank of Japan because this dollar drop. I mean, it's interesting, different sizes of the markets have different view on the dollar. Soft landing is a dollar's demise. But if you have a harder landing, where do you want to be? You probably want to be in that resplendent dollar, which is, of course, king dollar. And that's the theory. How hard is the landing? And that's the definition of what happens to the dollar. There's the euro.
Yeah, it's all about that dollar smile, right? Oh, yeah, this one's interesting. You have the data on this, right, Manus? Some pretty bad figures out of Europe.
Yeah, France, the services PMI, Danny, fell to 44.3. The forecast was for 46. So the Eurozone slump deepens. I'm off for a week. Drive, steer, and don't break anything.
I'll do my best. No promises, though.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think we are in this new regime. I don't think central banks have a better handle on what's to come next.
This is about inflation coming in better and the Fed adjusting as a result.
What we learned from the Fed is that we have to start entertaining our bull case a little bit more.
I think Jerome Powell is fixated on delivering this soft landing.
I've been calling for a softish landing. Now I think I just have more conviction in that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Can we say the year is over? Welcome back. This is Bloomberg Surveillance from New York City. Good morning. This is Bloomberg Surveillance. Tom and John are both off today, hoping to get prepared for the holiday season. Tom is helping John shop for bow ties. John is helping Tom decorate his tree. The good news for everyone is that I am joined by two amazing people, Katie Greifeld, Damian Sassower, who are going to join me around the table for the last day of the year. Can we say that, Katie, that this is the last sort of week of the year?
I mean, this was billed as the last week that mattered. We had so many central bank decisions. I know we have some data coming next week, but I think we can just quietly push to the finish now.
All I can say is that pivot party has turned into pivot mania. I heard that phrase from Bank of America. It seems like we're whipsawing into the end, Damian.
Yeah, that divergence between the Fed and the ECB over this past week is nothing short of spectacular for risk assets, EM included, but it's not quite over for EM just yet. We have a lot of central bank meetings next week, Hungary, Indonesia. We even have Japan next week as well.
Yeah, I actually saw some rate cuts over in Peru, and I thought, man, you're going to be really excited today. You're going to go crazy and cover that for us. I will just say that outperformance this week of some of the less loved areas really was what stood out to me. I was just calculating. The week-to-date moves include a 2% gain on the NASDAQ, about a 2% gain on the S&P, but Katie, 9% gain on the KBW index of banks, 6.2% gain for the Russell 2000. This is a true broadening out.
It took until, the last month and a half of the year, but we're finally getting that broadening out. And it's not just at the sector level. I mean, also small caps have been doing really well. It's not just these huge, heavy companies at the top of the deck that are outperforming. Now it's also those smaller companies as well. Even as you still have some people warning that, the cost of capital is really high right now. That's maybe not the best news for these smaller, weaker balance sheets.
Do you buy that, Damian, that this is sort of a head fake?
Well, it's kind of interesting. A lot of people are talking about fading this move, but then you have Jeff Gundlach from DoubleLine out there saying, no, we're going to see low 3% yields in the U.S. 10-year. I mean, we're not there yet.
But who's on the other side of that? And it's none other than Bill Gross.
Yeah, exactly. Right, exactly. Well, look, at the end of the day, you've got Mike Feroli at JP Morgan also kind of scaling back, saying, wow, maybe we are going to see a few more rate cuts than we initially expected in next year. Maybe we do need to front load a bit of those, but nevertheless, the verdict is still out as to what's going to actually happen there.
What I found interesting was that you saw real dollar weakness in the past week, and there seemed to be this idea that, people had been expecting the Fed to hold out and be behind the ECB, to be behind the others. It was anything but, Damian, as you were mentioning. Yeah. And now the question is, can we continue to see dollar underperformance if the U.S. economy is actually doing the best, right? Sort of how far can that dollar weakness go in light of true economic weakness, the likes of Europe and elsewhere?
Well, that's the real question, and a lot of that has to do with China, right? I mean, the euro goes as goes China growth, right? So from my opinion, you're going to be looking at China, but the data out of China is so opaque, and it's so difficult to get your finger on it this year, and I think that's really going to be, what a lot of traders are looking at as we come into Q1.
And all I can say, Katie, is that yes, the week is over, the year is over. But next week we get the Bank of Japan decision.
We do get the Bank of Japan. We talk about divergence among the Fed, the ECB, the BOE, and then you have the Bank of Japan just in their own league. So going to be interesting to see some of the commentary coming out of Japan. Also, we do have PCE, as you reminded me before the show started. You know, there is some stuff happening.
There is a reason to be here. I will be here. We will be here. So, you know, the year is not yet over. Taking a look at where we are in the morning, we definitely see that pivot party turning into pivot mania in terms of continuing some of the moves, albeit a little bit more tepidly. S&P futures are climbing to all-time highs on the total return basis. But really, people are gaming out now 5,000 on the S&P by year end, up almost 0.25% to 47.84. Kind of shocking, considering that that's year end targets for so many banks. You're seeing a little bit of dollar strength, retracing some of the weakness from the rest of the week as people are wondering whether or not good news is actually bad news or actually just good news for the dollar and for the U.S. economy. 10-year yields continue their descent, 3.9166. Just think that they started the week above 4.2% is sort of shocking. Crude a little bit elevated today. Not a lot of drama, but just to take you through some of the data points. In terms of economic data, Empire Manufacturing comes out at 8:30 a.m. It's the first read really on December manufacturing. S&P Global U.S. Manufacturing and Services PMIs come out at 9:45 a.m. We can see that economic surprise index in the U.S. has been inflecting upward. Again, this idea that a strong economy doesn't necessarily mean that inflation is going to restart, Damien, which is sort of this counterintuitive moment that we have this week.
Yeah, no, I mean, look, I mean, the economic surprise index, all that notwithstanding, is nothing new, right? I mean, this geopolitical risk premium that people are trying to bake into asset valuations, I mean, after the war, Israel, Hamas, all that stuff, it really hasn't had much of an impact. I mean, so, you know, I think from an investment standpoint, you really gotta look past that.
Well, one thing that has an impact is the deficit in the U.S. Now, come to the 4:11 a.m. We get from the Congressional Budget Office the CBO's current view of the economy from 2023 to 2025, including updated projections. Katie, we're going to start to talk about the deficit again. All of a sudden, people seem to have forgotten about that and just piled into long-term debt, and no one seems to be talking about that anymore.
Yeah, it's amazing because that was the real hot topic over the summer and really leading into mid-October when you finally saw that peak above 5% for the 10-year yield. It's definitely fallen out of the conversation. So I don't know. We'll see how those 11 a.m. numbers are digested.
And if that potentially could be a new narrative to end the year. At 4 p.m., we also get total net Treasury international capital flows to get a sense of just how many international buyers really are coming into the market. Is the year over? Joining us to give us a sense of whether we can all go home and expect a quiet couple of weeks or whether we can expect another narrative shift. Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. I want to just start there. Are you basically packing it up, rewriting your outlook for next year and saying we've gotten a pivot and we're going to lean in?
Hi, good morning. Great to be back. Really, this is quite a tricky one because we are very much of the opinion that these pauses that we're seeing, it's not a pivot. We are not there yet. And the problem is that as much as I don't see, I'm going to jinx it now, but as much as I don't see any major upsets for the rest of this calendar year, as we head into, we always have to be looking forward, as we head into Q1, and slightly later on next year, I do think this market is behaving in a way that thinks that rate cuts are absolutely imminent and that we're going to have this Goldilocks scenario. And I don't currently see that. And I think that there could be quite a divergence here between what interest rates and the trajectory there actually is and what markets are expecting. So I don't want to be a downer here, but I do have some concerns around that.
Sophie, the Nasdaq's at an all-time high. The S&P isn't that far off. I know you're calling for a little bit of a shift from growth to sort of not value but quality. I wonder if you could, expand on that a little bit. When you say quality, are you talking about income generation? What do you mean by that?
Yeah, absolutely. So I think, what we can say for sure is that there is just so much uncertainty still. And that divergence between what banks are going to do, central banks are going to do, and what the markets are expecting means that, we think that investors should be really trying to place a little bit more quality into their portfolio. And by that, I'm talking about your more old-fashioned names, potentially, names with really big brand moats where they've got a bit more reliability over revenue. This obviously spans a lot of different sectors. There's a big consumer conglomerates that account into this. You've got aerospace and defense that have got order books. They know what's coming down the pipes. But then also within that, there are really a lot of reasons to be focusing on income as well. And particularly, shout out here, the UK has some really quite compelling options there. So that's maybe slightly away from the quality pure play. And I'm talking about, there's some really unloved names here in the UK that still have pretty low payout ratios, which makes them more resilient when it comes to paying dividends. And I think that they could also be worth a little bit of attention.
Well, Sophie, before we get to the rest of the world, I want to talk about how big tech fits into that quality narrative, because you talk about brand names. I mean, I think about Apple, Amazon, Microsoft, et cetera, that have just amazing cash flow. How do they fit into that?
Sure. So I definitely think that they do hold a place. You know, I'm certainly not saying that we need to forget tech and AI more generally. But we know that picking the next big technological game changer is an incredibly difficult thing to do. So when you're looking at this, particularly through the lens of AI and what the winners are going to be next year, we absolutely think that it makes sense. And the best way to gain exposure to that is to do so through companies like you've just mentioned, where actually their core businesses are incredibly cash generative. Demand is relatively reliable. It's certainly not guaranteed, but it's a lot steadier than others out there. So I do think that tech definitely still has a place, but we need to be careful that people aren't overweighting towards that area. You know, the US more broadly is looking relatively close to fair value. So definitely have a nod to it, but it's not the be all and end all, and still focus on companies that have extra pillars to support them as well in the coming months.
Well, on AI, that's a really interesting point, that it's really hard to identify the game changers at this point. It sounds like you're saying to not necessarily go all in on those AI pure plays.
Absolutely. It's the experts get this wrong, and it's really difficult to call with things that are so fundamentally huge. I don't even think mega trend is the right word for this. So certainly don't ignore it. That wouldn't be a good thing to do. But absolutely focus on those companies that have the deep pockets to throw at this. You know, Apple has it, Alphabet certainly does, as does Amazon, Microsoft. But they've also got good underlying businesses. So rather than looking at the kind of the more the startup-y angle from this, or those with less of a proven track record, maybe have a look at companies that offer you a little bit of diversification within that AI play, and then you get the best of both worlds.
There's a sense, Sophie, that you like outside of the U.S. more than you like the U.S. simply because they're discounted shares, and yet we are seeing the economic data diverge quite considerably in terms of just the flash PMIs that we got out of Europe earlier this morning. How do you justify the idea that there's more room to run in some of the European equities at a time where we still have a somewhat maybe lacking conviction, but hawkish ECB head, and you're also dealing with souring economic data?
Sure, it's definitely incredibly tough. And there are definitely pockets, particularly within the UK and the wider EU, that we wouldn't be getting particularly excited about, say. The difference really is that particularly in the UK, there are some situations where things have been pretty harshly oversold, in my opinion, and there is great income potential there that is potentially being ignored. That said, the US definitely has a great deal of incredible companies, and as you're saying, the resilience of the economy has been absolutely phenomenal, and that couldn't and shouldn't be forgotten. But what I would say is this idea of a soft landing or zero recession is also not guaranteed yet. Particularly for me, data points that I look at, you look at the rate of increase in interest payments on personal items. So everybody's very focused on mortgages, but you look at personal items, that is a really quite scary gradient, and I don't think that this that kind of idea of consumer weakening and economic activity slowdown is necessarily being fully priced in.
Sophie Lund-Yates, thank you so much for being with us. Sophie Lund-Yates of Hargreaves Lansdown joining us as we parse through the rubble that has been the past couple of days, honestly. What a tremendous reset, given the fact, Damien, that so many people were expecting the ECB to cut rates before the Federal Reserve. starting early next week.
Yeah, I mean, look, dollar weakness has been a feature of this move, right? And how long that can continue, how much runway is there as we head into 2024, it really remains the key question, certainly for me as an emerging market strategist. But, you know, it's interesting, what's the impact on equity earnings from that? You know, Sophie mentioned UK equities, which are, you know, the valuation discount, but I'm not convinced there. I think it's largely a currency story, and we'll see just again how much runway there is for dollar weakness.
Which really goes to your point, Katie, which is essentially the earnings have been really solid in the U.S. When you look at tech, that's been an unbelievable driver. It must be exhausting for fund managers to get that question. It's like, we don't want it because it's so overvalued, and yet it's not overvalued when you look at the cash flow.
Especially when they're trying to pitch the rest of the world, they're trying to pitch European equities. The bare fact of the matter is that Europe doesn't have the American tech companies, and unless you get a really sustained broadening out of this rally, it's a hard sell.
Which is the reason why we keep seeing the U.S. outperform. This morning, you are continuing to see it outperform just a touch when you take a look at the dollar, regaining some of the ground that it's lost pretty aggressively over the past week. The euro, 109.65, just a heartbeat ago, it was 107, and then 106, and then 105, and people are talking parity, not so much anymore. 10-year yields, 3.91%.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while
This is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley.
What needs to happen to end the war today is the conditions I just laid out. And there's three of them, and they're not that difficult. Lay down your arms, turn over those who were responsible for the October 7th attacks, and give up all the hostages. Three simple things, and this thing could be over. It could be over today.
That was National Security Council spokesman John Kirby outlining the three conditions for Hamas in order to end the war. This, as there is a real shift in tone with respect to the U.S. administration, really cautioning Israel to take more of a surgical approach and start to shift away from some of the airstrikes. We've been talking so much about the Israel-Hamas war that we have lost focus of another war that's been raging, which is Ukraine, and we've been focused all week with respect to whether they can get aid from the U.S., but also from the European Union. Let's get straight to it. This is a really important conversation. John Lieber, Managing Director at the Eurasia Group and former policy advisor to Senator Mitch McConnell, joining us right now. And I do want to start there, John, considering the fact that it wasn't just the U.S. that failed to pass aid after Volodymyr Zelensky came to Washington, D.C., but overnight, the EU as well, also failing to get anything through before the end of the year.
Yeah, I mean, but a lot of veto points in it, and it makes it hard to get anything done. But in the U.S., this is less of an urgent issue that is in the EU, which of course also has a lot of veto points, because any one country can stop the aid from flowing for now. ultimately, this is a much higher stakes issue in Europe than it is for the United States, and probably the Europeans are going to be potentially more reliable partners than the United States is. But it looks right now like the U.S. is set to punt on this issue, perhaps into January of next year, when further funding for Ukraine will be tied up not only in the Congress's ability to negotiate border funds, but also in their ability to avoid a government shutdown. So this is a really messy negotiation right now, and the outlook does not look great for the continued major flow of weapons and support that we've seen to Ukraine so far.
Well, John, that's what I wanted to talk about, the point that you made that this is a higher priority, a bigger issue with more urgency when it comes to the EU. You take a look at what's happening in the U.S. Congress, that debate between more U.S. aid for Ukraine, whereas the Republicans pushing for more border security. Who do you think, what does the compromise look like there, and how does this evolve in January?
I think the Republicans have the upper hand in the debate right now because they have the ability to veto any additional aid, because Speaker Mike Johnson can just say, thanks for your effort to the Senate. I'm not putting your bill on the floor unless I like it. There's almost certainly enough votes in both the House and the Senate to pass more Ukraine aid plus more border funds. The Republicans are using this as a leverage point to hold out for everything they want on the southern border, changing the asylum rules, creating more ability for the government to deport illegal immigrants. And the Democrats are saying, no, we aren't going to do that. They think this is inhumane, and they don't want to treat migrants on the southern border that way. And they're at an impasse. So I think ultimately the compromise is going to be something like what Biden proposed, which is tens of billions of dollars in additional aid for Ukraine, but the whole plus the border, but the whole thing could fall apart because the two sides just are not close to agreeing on this border issue, which right now is the linchpin towards getting a deal.
John, I'd like to shift back to Europe here. I'd like to talk about Hungary. I'd like to talk about Viktor Orban, the Fidesz party. I mean, what is going on there? I mean, does Viktor Orban represent the belief of the Hungarian people? I mean, they are holding up the 50 billion odd in funds to Ukraine at this point. They're the only EU member doing that. What comes next?
Yeah, they're holding up the money, but oddly, they did they walked out of the room when it came to the Ukraine accession talks. So it seems like they're playing, what kind of game he's playing is really unclear right now. Obviously, Orban's trying to flex some muscle inside the EU and make sure that Hungary's influence is felt. And they're going to revisit this next year as well. I think that for both of these bodies, this debate is far from over, and there's still some more negotiating and horse trading that can happen both within the EU and the United States. But it's hard to say exactly why Orban's doing things this way. It looks like he's just trying to increase some leverage over the EU for Hungary.
Well, John, Hungary is generally viewed as, the closest ally to China within the EU. I wonder, can we read anything into that? Is China, kind of pulling the strings behind the scenes?
A little difficult to say, especially at this point. I think the outcome yesterday was a little unexpected, particularly on the fact they let the Ukraine ascension go forward. I think that's a sign, that's a long-term process. It is going to take many years probably for Ukraine to qualify for EU membership. And it's really difficult to say what China benefits from the EU not funding this war. I think what China wants is probably an end to the war as quickly as possible, but not necessarily on Russia's terms, which is where all of this is going to end up if the Ukraine can't get more aid out of its Western partners.
Just to sort of put a bow tie on that, are you basically saying that Russia will win if Ukraine doesn't get more aid?
If Ukraine doesn't get more aid, Russia has the upper hand. They've got the manufacturing capabilities and the patience and long-term time frame to wear down the West. So Ukraine really needs the West to step up here. And if they don't, they will win this war.
In the meantime, we also are dealing with the Hamas-Israel war that keeps going on. But there seems to be a real tone shift from this administration, really warning Israel against more kind of indiscriminate airstrikes or more broad-based military action and more sort of surgical types of procedures going forward. How big of a deal do you think this is?
Yeah, I think as the kind of horrors of what happened on October 7th fade in the public's imagination, the political liability for Biden of the Israeli response in Gaza is growing. And Biden there's a lot of damage that's already been done for him domestically among the progressive left and young voters, which are both important parts of his coalition. And I think that the humanitarian situation in Gaza is becoming untenable for the United States to support. Now, of course, Biden's only shifting his tone. The U.S. is still supporting Israeli militarily and will continue to do so for the foreseeable future. There is a broad consensus in the United States Congress that Israel has a right to defend itself, and it will continue to do so with U.S. support. But for Biden, this is becoming a political liability, and I think that they're going to start putting more and more pressure on Israel privately and publicly to be more tactical in what they want to do and how they approach this. But that doesn't mean that Israel is going to stop, and it doesn't mean that the U.S. is going to stop supporting them. It just, what the U.S. wants to see is a hastening to the next stage of this war, where Hamas is removed, and then you can move to a kind of post-war period and rebuilding.
Well, John, to your point on political pressure, we're talking about how the Biden administration is handling this. But let's talk about Joe Biden, the presidential candidate. Of course, we're, 11 odd months out from the presidential election. You think about these hot wars happening in other parts of the world. How is the American voting public ranking that when they're heading to the polls?
I think the wars are bad for Biden because it gives this narrative to Trump that the world is on fire. And Trump, ignoring COVID is going to say, when I was president, we had peace, we had prosperity, we had growing real incomes, there was no inflation, and you didn't have all these wars around the globe that he's going to attribute to President Biden's withdrawal from Afghanistan. So as a political matter, the wars are going to play in a pretty major way in the narrative of the U.S. election next year, even though foreign policy is typically not a top issue for American voters. And I think that very much works to Trump's benefit. There's nothing Biden can do about it. He is committed to funding Ukraine if he can get the money, and he's committed to allowing Israel to defend itself. So this isn't Biden's choice, but it's going to be a problem for him next year if these wars are both still raging in the middle of the U.S. campaign.
John Lieber, thank you so much for being with us of Eurasia. We appreciate the insights, especially at a time of growing concern around both of these conflicts. I will just say, Katie, you were mentioning the election season coming 12 months away. It doesn't feel like we're less than 12 months away from an election.
I know. Time is passing incredibly quickly, and we really are expecting that to pick up in January. We know that the Trump camp is planning a big push, especially when it comes to Iowa, so a lot more of that.
Do markets care, Damien?
Well, I mean, they haven't recently, if you look at the price action. But I mean, look, I think, yeah, certainly what I'd love to have gotten John back on here, because the fact that he's saying that the wars are bad for the Biden campaign, I'm not so sure about that. Sometimes war can actually be a good thing in an election year, go figure. If you have both parties coming together and believing that, for example, you should be in support of Israel or in support of Hamas one way or the other, yeah, it can sometimes be a good thing.
The problem is, of course, right now, there's so much internecine disagreement for the Democratic Party in particular. And so how do you then get a coalition within your party if there is so much disagreement? We'll be talking about that going forward. We're also going to be talking about China. We did get data overnight, a bit of mixed kind of signals in terms of the economy over there. I'm so pleased to say Bill Lee, chief economist at the Milken Institute, will be joining us to break it down, what the chances are of some sort of stimulus, as we do see the pivot party turning into pivot mania here in the United States.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
What a week, an incredible week of rallies, both in bonds and stocks, as people embrace the idea of a pivot. The party turns to a rager as people get an endorsement, essentially, from Fed Chair Powell. S&P futures up 0.25%.